This video is the ultimate Bybit tutorial. I'm going to show you the entire platform here, including getting money in and out of Bybit, how to trade both in the spot and futures market, and use all the other different types of markets here as well. And then under finance, there's lots of different things we can do with our crypto. I'll show you what all of these are, how to use them to your advantage, and timestamps for everything down in the description below. If you're brand new to Bybit, just come and sign up. It's an email address and a password is all you need. Now, if you are new to Bybit, make sure that you look at the link below in the description. You can get up to $30,000 as a deposit bonus, one of the best bonuses in crypto. Whatever you deposit, you can see you'll get something there. So go ahead and sign up by that link. Now, a lot of people can't use Bybit. Some countries they just don't operate in, which is why I'm going to show you Bybit Web3 as well, which has lots of other features that a lot of people can use. Now, Bybit also run this, which is a decentralized exchange if you're in crypto already. So you can get a permanent fee discount on ApeX. I'll show you all of this and what it actually means in this video and how to use ApeX and Bybit and Web3 as well. But some really good offers if you are signing up for an account. So you can check the links below for all of the details. Some other resources that I'll go through that you may need as well will all be linked down there. Once you've set up a login with an email address and a password, we need to go to our account settings first. So when you log in, go to your account icon and then go down to account right here. And then it takes you through to this page. You've got your user ID here, which you won't really ever use, but it's your user ID for your account. And then top left is your username, which is your email address, but you can change this to something else if you want to edit that. The first thing we need to do though is identity verification right here. So I'm going to click verify now, and you can see that I'm already verified. Bybit can't offer financial services in every region, and they don't operate in every country. So if you have been able to set up an account, then they will operate where you are. But if you can't, then we also have this Web3 option, which anyone can use from a crypto wallet as well, which I'll show you throughout this video. But to offer financial services, Bybit need identity from you. So passport, driving license, ID card. This is the same for every single crypto app. And you can go and verify that. Now you need one of those on your computer as a scan or a photo. You can also do it on your phone if it's easier for you. So go and download the Bybit app. You can take a photo of your ID and then you take a face scan to prove that it's you on your ID. That's going to populate with your official name and the country of residence. That's really important for financial reporting, and Bybit have to do this, right? These are just regulations, so go and verify. You can also get advanced verification if you want to give them proof of address, like bank statement or utility card bill. That's going to give you much higher amounts that you can withdraw from the platform if you want to do that. But ID is important, so go and do that, and then you can use all of the features within Bybit. Now that we're waiting for our identity verification to go through, just make sure you've got security set up properly. So login, password, and email, that's just your account details that you set up. Down here, I would suggest putting either Google two-factor authentication or passkeys on your account. When something important happens, for example, withdrawing money or withdrawing crypto or something else, it's going to ask you to prove who you are, right? And so this prevents someone hacking into your account and basically draining the account. If you use Google already, this is Google Authenticator on your phone, then this is going to be easy to set up for you. This is where Bybit will have a QR code. You go and download Google Authenticator on your phone, scan the QR code, and it links up Google Authenticator with your Bybit account. There's a 6-digit code that refreshes every 30 seconds, so you can prove who you are. That's great, but it's a little bit clunky. Passkeys are great as well if you want to set these up. This right here sets up a passkey on your device, and then you just log in via your passkeys, which is biometrics. So Face ID or Touch ID or whatever you have. Google, Android, and iPhones have this. You can set up a passkey. It actually saves one of the keys in your account on your phone, either Google or Apple, and then you can log into Bybit. It's basically the same as Google Authenticator, just using passkeys on your device rather than a 6-digit code so that you don't have to remember that. If you lose Google Authenticator on your phone, it becomes a really big issue disabling it and then adding it again. Passkeys may be a bit easier for you, but at least one of those. Once you set up passkeys or Google Authenticator, the other security measures aren't massively necessary, but you can set them up if you want. For example, a whitelist right here, you can set in a bunch of crypto addresses that you regularly send to, and that means that you can very easily send to them. You don't have to go through all of the security measures. But if you want to add another crypto account to the whitelist, then you have to go through all of the security measures just once, and then it's a bit easier to send out next time. That also prevents anyone from hacking in and trying to send assets out of your account to an address that you've never sent to before. So you can set this up as you want. The main thing is either passkeys or Google Authenticator as the extra security step. Bybit also let us set up sub-accounts. So in your same settings page, this sub account option here lets you set up multiple different accounts within your main Bybit account. The reason people may want to do this is because they may have different accounts with different money in there for certain different activities. So for example, your main account, you may actually want to use Bybit basically like a crypto bank, because Bybit have a card which you can easily spend crypto from or fiat currency from as well. So many people may have their main account, which they use more like a bank, and then they may have a sub account where they take on riskier trades or day trading or anything like that. So if you want to set up a sub account, just go ahead and do that. Click the sub account page, go to create sub account. That's going to have a brand new account that you can actually put crypto or assets into that will be separated from your main account. So you can trade in one and then have savings assets in another or something like that. The other thing we need to figure out is our fee rates. So we can click this. Now, if you're a brand new user, you may have the normal fee rates on Bybit, which start at around 10 basis points. So that is in the spot market. You will pay 10 basis points for all of the volume that you trade. So if you buy crypto, whatever the value of the crypto is or the trade is, that's 10 basis points out of the trade that you pay Bybit in trading fees. When you sell out of it again, that's another 10 basis points. So every time you make a trade, it's 10 basis points. Now, they also give fee discounts as well. So if you're a VIP in certain ways, you can either have an amount of crypto on the platform, or if your trading volume is very high, you get VIP rates, which the trading fees actually get discounted over time. So you can see this in your fee rates anyway. The maker-taker volume, I'll explain that in the trading section, but you may get some slightly bigger discounts if you're a maker of liquidity on the platform, which I'll explain later. It's fine, but the differences are absolutely tiny. Now, if you trade derivatives, as you can see here, they are a different trading fee structure, which is usually lower, so cheaper than the spot market as well. And then you can see all of the different fee rates here. So you can figure out what it is and if you want to be a VIP via how much you put on the platform or how much you trade. Bybit also perform regular attestations to prove that they're holding all of their client assets. This is an industry standard way of just making sure that nothing crazy is happening. So go down to audit, and then you can see all of the different proof of reserves right here. Now, if we go to a third-party site like DeFi Llama, you can see all of the top exchanges do this, and they're just proving that the assets are there, they're not doing anything crazy with them, and that they are proving the reserves are in the wallets that is controlled by the exchange. So you can see Bybit is a top 5 exchange worldwide. You can see the assets that they say they have, and then the proof of reserves knowing that they control the wallets that those assets are in. So go ahead and prove that if you want, but you can see this on Bybit's website and on third-party websites just to prove that nothing's going crazy, but Bybit is one of the top exchanges worldwide, so we wouldn't expect anything weird to be happening anyway. Now, if you are brand new to crypto and trading, you can actually use the demo trading feature on Bybit. So go down to your account settings and then demo trading here, and it takes you through to basically the exact same screen as the live markets. But the difference here is that you can trade with paper money. So everything is exactly the same apart from the fact that the money you trade with isn't yours, it's just paper trading. But you can basically practice here, make some mistakes. You can see Bybit demo trading, this icon here, which means you aren't making real trades in the market, but the prices are the same, all of the buttons are the same. So if you are brand new and you want to practice, click on demo trading. During the trading section of this video, you can click on demo trading if you want and just practice without any real money at stake. Bybit as a trading platform basically has 4 main product areas that we can go ahead and use. Buy crypto is a fiat currency on and off ramp. So you need to get money in to trade, and then if you want to get back out again, you swap it back to fiat currency and off ramp it. Now, Bybit doesn't have the best fiat currency on and off ramps in every region, to be honest. A lot of people use a different platform as an on and off ramp for fiat currency in their region, and then actually send crypto to Bybit to trade. The reason being is that Bybit's trading fees are way cheaper, and so a lot of people do that. I'll go through that in that section. Trading here, we have many different options. The spot market is where most people go to invest in crypto. That's where you swap your money for crypto. You buy the crypto, you own it, and you can withdraw it from the platform. Futures and options are known as derivatives, and that's because they're actually not buying and selling the underlying asset itself. They are a derivative on top where you only trade the price. So for example, with futures, this is actually a contract that you trade, and it's just the price of the asset. So you can go long, which benefits from the price going up, or you can go short, which benefits from the price going down, and you just benefit from price movements and you don't buy and sell the underlying asset. The reason people trade that is because trading fees are cheaper, and also you can take leverage, which means you can trade with more than you own. Or you have on your account. Now that increases risk, which I'll go through during that section. Options as well, completely different. This is where you trade some option to do something in the future. So you can take a position which benefits from the price going up or down, or you can hedge out your exposure. So if you have a load of Bitcoin and you want to sell at a higher price, you might want to do that with an option. Lots of different reasons why, which I'll go through in those sections of the video. You can actually trade gold and FX now on Bybit as well, plus a few different early investment and pre-market trading options, which I'll go through. Now, the other option right here is tools. And there's a few different things here. For example, you can actually add TradingView alerts if you use TradingView, which is a separate charting platform, which is very good and free for the most part. You can also use copy trading, where you just put some money in and copy people's trades. These are a little bit on the edgier side, which you can use if you want, which I will go through. But then we have the big kind of finance option, which is a bunch of different ways to earn, either through lending or through staking. Again, crypto assets can be staked, so you can earn some money from them. So Bybit let you do that pretty easily with low fees. Or you can go to the earn section, which is maybe where you lend out some of your assets on the platform to other traders and they pay an interest rate. You can actually take loans against your crypto as well. So if you have some, let's say, Bitcoin on the platform and you want to take 10% of the value of it as a loan in USDT, right, which is a stable coin, bit like US dollars, then you can do that on Bybit as well. There's going to be an interest rate that you pay for the loan, etc. So there's a few different things here. And then we have under finance, we have the card as well, which is a MasterCard. So you can just put balances on the MasterCard and spend from your crypto account via the card. So we'll go through all of this in this video. Bybit ran a fantastic VIP program. It's very competitive when you look at the benefits that you get versus the requirements, especially compared to other exchanges. It's right up there. So if you have an account, go to your account card here. Just this icon is going to show you your user ID and your username. At the bottom of this card, it should say either upgrade to VIP or look at your VIP benefits because you're in one of the tiers. So click on that and it takes you through to your specific page where you can see exactly what you've got from the VIP benefits. Now, I think the three main benefits here are firstly, cheaper trading fees. Right, so the higher tier you just get lower trading fees, which is obviously awesome. The second thing is getting cheaper interest rates on loans for VIPs. So, a lot of people borrow a little bit against their crypto instead of selling the crypto because they don't want the tax liability and they borrow against it. Cheaper interest rates is great if you want to do that. The third one is cash back on the Bybit card. So most regions, I think, do have the Bybit card now. I have it. I use it, often. And so you get cash back in VIP tiers on the card, which then you can roll back into crypto if you want, right? And which over time can get you even more cash back on that bonus that you had. So they're the three for me, but there are many others. So I'll go through them very quickly here. You can see some of the benefits, lower fees and interest rates. You do get Bybit specific reports on certain things. You can see that in your VIP account. Priority access to customer support is very, very good, right? So if you've got any issues, just go to customer support and you get VIP access, right? So you don't have to wait around. But they also give you, in some tiers, a unique person who is your VIP contact where you can actually just message them, right? So they give you their contact details either on Telegram or a couple of other apps. And you can just say, hey, look, I've got this issue or I want to do something. And they'll just get back to you, which honestly is amazing if you have any issues with the platform. But there are many others, as you can see here. Higher withdrawal limits, other Bybit products where you get benefits. For example, in the launch pads and everything like that, you get potentially higher allocations for VIPs and everything like that. So there's a lot to do. Like I said, I'll leave the link below to Bybit. If you are signing up for an account, you can see the VIP tiers as well, and then you get that deposit bonus anyway. But the VIP program, certainly, if you are putting a little bit more on the platform or training a bit more, it's one of the most competitive out there when you look at other exchanges. There are 6 VIP tiers and you can compare the benefits of these. It just matters either how much you trade, so your trading volume on a monthly basis, or how much you have on the platform, the value of your crypto on there. So go back into your account, you can click this card again and then compare these benefits. So VIP 1, 20% discount in spot, 27% discount on derivatives, 2% cash back on the card, and then you get some discounts if you are depositing fiat onto the platform, if that's available for you. VIP 2 doesn't add too much to that, but you can see you get even bigger discounts in your trading fees. VIP 3 increases the discounts further and you get 4% cash back on the card at that point. And then you can see here down at the bottom, you get some VIP gala events and gifts as well. And then as you go into VIP 4, 6% cash back on the card, huge trading fee discounts. VIP 5, I think you get up to 10% discount as you go into Supreme VIP. But obviously this requires a ton of trading volume or assets on the platform. I'll show you how to qualify for the separate VIP tiers then, and I will link this page down in the description if you want to go through this further. But any one of these tiers is going to get you into the VIP tiers. So for a lot of people, it may be asset balance or trading volumes. You can also borrow from the platform. So if you have some borrowing, you can see here that gets you into the tiers. But for asset balance, anything over 100K in cash settled crypto or fiat currencies is going to get you into VIP 1. 250 for VIP2, 500,000 worth, a million worth, and then 2 million worth for VIP5. Nothing for Supreme VIP. I guess this is more for family offices or hedge funds that are putting a lot of trading volume through the platform. So you can have an asset balance and not trade at all and still get the VIP tiers. If you borrow, you can get the VIP tiers if you borrow this much. And then for trading volume, you can see over $1 million in 30-day trading volume in the spot market gets you into VIP1, and then that goes up. That's quite a lot for spot trading, but for derivatives, a lot of people use Bybit for trading derivatives, and 10 million in trading volume isn't that much for derivatives because a lot of people use a bit of leverage. And maybe they trade in and out a little bit more often, and so that can get you into the VIP tiers. In any case, if you meet any one of these, just one, not all of them, but just one of them, that gets you into that VIP tier, and that will last for at least a month. And after that, if you go under these, it's going to just say to you, hey, do you know that you've missed out your 30-day trading volume? We're going to have to move you down to the tier, and if you have trading volume again, we can move you right up to that tier. So that's how that works. If you don't meet the requirements, they move you down, but if you then actually meet it again, they just simply move you up on that same day. So I'll leave this link below if you want to go through it further. If you're fairly new to Bybit, your account structure should look the exact same as mine. I updated mine a while back. Go to your assets, go to asset overview here. That gives you this page. This is the accounts that you have. There's 3 here, and then there's the Bybit Card if you can use that as well. Go to funding. Funding is where assets go when you deposit them onto the platform. They just sit in your funding account. They're not in the Earn platform. They're not in the trading system or anything. Just keep them here like a savings or a bank account. You have crypto here. You can see your balances. You have fiat here if you deposited any fiat. And if you want to withdraw it, then that's where your fiat will be to send out. And on the right-hand side, the options for that asset are available. So you can deposit and withdraw it. You can transfer it internally. You can trade it, buy and sell, as you can see. So the options for each asset will be on the right-hand side. Now, unified trading is where assets go to trade. So if you have some money in your funding account and you want to trade it, you have to switch it into your funding, into your unified trading account. So go to transfer. From here, we want to transfer from funding into unified trading. I've got 20 USDT, I can press confirm. That switches from funding into trading where I can go ahead and buy and sell the asset. Now, I'll go through this in more in-depth detail with the futures section, because when you trade futures, you actually use assets as collateral to trade with, and you can choose that option right here as well. I'll go through that later. If you're just trading in the spot market, it doesn't matter, these options. You can just trade and then send it back into funding. Earn platform, if you are lending out assets or staking assets, you'll see them all here. That's separate from your funding and your trading account because those assets are locked up in Earn. Now, you also have Bybit Card if that's available for you. Bybit Card uses a bunch of different assets to actually spend in shops. So it's a physical card. I have one. It's a MasterCard. You can just spend crypto in shops. Now you can choose to spend fiat currency or multiple different crypto assets if you want. And I'll show you that in the card section. But the Bybit Card takes money from your funding account. So if you do have money in your funding account and you've chosen some assets to spend, that's where it will take the balances from. And you can choose to spend Bitcoin or stable coins or fiat currency as you want, and that will take it from your funding account. So that's basically the different accounts that you have within Bybit where money can be stored or spent from or traded from. Now let's look at depositing money into Bybit. So press buy crypto here. That takes us through to this page. And there's a few different options, but underlying this, there's only 2 ways to get money into crypto. One of them is paying via a debit card, and the other is depositing money via a bank transfer in your region. Now, cards are easy but very expensive. You'll be paying around 2 to 4% in fees, foreign exchange fee, exchange rate, etc. And it's going to work out about 2 to 4%. Not good for larger amounts. The better way is to try and make a fiat currency deposit. So send a bank transfer from your bank into the banking details of Bybit or one of their third parties. Bybit doesn't have banking links in every country, so what they do is use third-party on and off ramps. MoonPay, Transact. These are separate companies that specialize in fiat currency on and off ramps into crypto. So you send them the payment, they link that payment with your Bybit details, and then send the money into your account. So there's 2 ways to do that. Depositing fiat is the easiest way if you can do that. Now, also underlying that, you have different currency support in Bybit. So depending on which region that you're in, you may have really easy access to depositing money in, and some other regions don't. So in my region, I don't have direct bank links. And so it's very difficult for me to send bank transfers into Bybit. I usually have to go through another party and then send the money into Bybit. The reason being is that Bybit have cheaper trading fees than most other exchanges and just a better trading system. So I'll show you how this works. So let's say in my region, I'm going to say that I want to spend my currency. So I'm going to spend an amount, and it's going to tell me, well, this is how much USDT you will receive. So I want to buy using fiat currency, and I'm going to get this US dollar stable coin. Now, if you press this, you can just directly buy the crypto that you want. So if you want to buy Bitcoin, ETH, Solana, BNB, or whatever it is, you can just search for it, and it's going to come up and you can directly buy it. Now, the problem with that is it's going to give you an exchange rate that you may not know if it's a good exchange rate or not, right? And so you'll have to work out if the exchange rate is good. Yeah, it won't be very good. It's going to be a bad exchange rate because this is kind of like buying currency at the airport, right? It's going to be pretty expensive. But in any case, let's just go through. I want to spend this and I want to buy this stable coin here. And it's going to tell me that my payment methods are bank or Apple or Google Pay. Right, so this is what I can do. This is going to send me over to one of their third parties anyway down here. So down here, these third parties are not Bybit. They're fiat currency on and off ramps that you can use. So let's say that I want to choose this one right here. So I press that, and then I can press buy with AED, and it's going to take me through, and it says, look, Bybit isn't going to take this payment, right? They don't have this link. They're using one of these on ramps, right? And so you are going to spend this amount. You're going to get this, but you can see the exchange rate here. Now the exchange rate should be the proper exchange rate is 3.68, and I'm getting 3.71, right? So I'm getting a worse exchange rate to exchange my dirhams for dollars. But if you want to go ahead and do that and pay the fees, press I have agreed to the terms and conditions, then press continue. Now what this does is send you out to the third party to actually go and sign up with their exchange, their on-ramp. You do KYC there and have an account there, and then you can link your Bybit account to the third party. I'll just show you one of these third parties, right? So what you would have to do here is go and log into this and set up an account. Now, you may not have to do this if you're using Bybit. They may just send you over. It's going to show you this page right here, and it's going to say, yeah, sure, you can buy this, but you're going to need to do KYC, which is you have to give them your ID card or your passport again, prove who you are, and then it links your Bybit account with that. You make the payment through the card details or whatever that is, and then they actually take that payment from you, and then eventually that money will find its way into your Bybit account because obviously Bybit will link up with these third parties and they know your Bybit account details, and they'll eventually deposit that into your Bybit. That is a long-winded way of doing things, but if you don't have Bybit direct links in your country, you have to go through a third party. Unfortunately, a lot of these third parties anyway only accept card payments, which again is the most expensive way to do things. I'll also show you with a more accepted currency, something like the euro. So 200 euros, I want to put that into USDT or Bitcoin or whatever else, and it's going to give me the payment methods as recommended is either card payments, again through the third parties there. You can scroll down and see these third parties have worse exchange rates, or we can actually spend with fiat balance. Now, that means that Bybit are accepting euros to be deposited in. So what we're going to do is go to fiat deposit. If you go to these options, you can see fiat balance here or fiat deposit. So we'll click that up here, fiat deposit. This is where we send deposits into Bybit, and this is going to be the cheapest way. So now we're getting into banking transfers or fintech app to another, Bybit account. So fiat deposit, euro. Now again, not every currency is supported here. So we'll go for euro because it is supported. And then it says you can send in a SEPA or use Zen.com. Zen.com is a fintech app. So again, you have to go and sign up for Zen.com and actually send that in. If you can send euros from Wise or Revolut or something like that, you can actually transfer your currency into euros and then send euros in. Just make sure that your account details and ID details and name are the same on both accounts. Otherwise it won't go through. But again, for SEPA, there is a slight fee here, but way cheaper than any card payments. And of course, this is just sending in fiat currency, which means you will actually have a fiat currency balance within your Bybit account. That's important because you can use that to spend on the card, or you can use it to trade in the spot market on Bybit, which has very, very low fees. So you're basically paying way lower fees than using a card. So if you want to go ahead and do that, press one of these options for the currency that you're using. I'll press continue here, and it's going to ask me, I think, to complete a questionnaire. So you have to go through this, and because you're dealing with fiat currency, you have to tell them some of the details, right? So what do you want to do? Fiat deposit, and I'll just leave it at that, maybe under 5,000, whatever you want to do. Go ahead with this questionnaire, right? Just tell them your details here. You can see nationality and residence. You have to prove your residence, right? So if you want to deal with fiat currency, a residence proof, when you're doing KYC, which I showed you earlier, you will have to give them either a bank statement or a utility bill to prove your residence so they know where you're sending the money from and everything like that. Declaration, do that first. Then they will let you send in the euro via your SEPA details or your other fintech app. So that can work if you're in Euroland. For some of the other currencies right here, you can see what is available for you. Some of these currencies are available to send in, some aren't. But you can go ahead, once you've filled out that questionnaire, it's going to give you banking details, and then go over to your bank or your fintech app with euros and send a SEPA transfer over to the banking details that you get to Bybit. There is another way to get assets into Bybit, which is using peer-to-peer payments. Now, this is where you use Bybit as an escrow agent in the middle. And so it's you and another third party, usually some sort of money changing service in your region, which will be a separate business. And basically you send the money to them in your region, either via a bank transfer or something else. And then once that payment has been accepted and hit their account, the crypto is released from their Bybit account through escrow into your Bybit account. Now, there's some issues here, of course, with you're paying someone that you may not know. These are obviously small businesses or something like that, which increases risk of something going wrong, or you're sending the money over and they say that they didn't receive it. So not a lot of people use peer-to-peer. But what you would go ahead and do is press buy and then choose the asset that you want to buy. So let's say we want to buy a stablecoin here. Choose the fiat currency that you want to interact with. So I'll just stick with euros. And you can see all the different payment methods. These are the different people that you would send money to. This is the exchange rate that they're giving you. And then it says here, Euro balance, TBC Bank. There's a few others. If you go down the list, there should be some that accept payments through Revolut and some on Wise. You can see right here. This is for smaller amounts because Revolut and Wise are going to probably flag some big transfers from one Wise to another or Revolut to another. And so there's lots of issues here that can crop up, which is why people don't really use peer-to-peer that much. It can work for smaller amounts, but you don't want to be doing larger amounts like this. So what a lot of people do actually, if they are having issues with putting money into Bybit, is using another quality on-ramp in their region. And so I'll show you that now. What you may also want to do, and what most people in crypto do, is actually sign up for multiple exchanges where one of them is your best fiat currency on and off ramp. And those tend not to be the best trading systems. They tend to be a little bit more retail focused, a little bit more expensive, and the trading systems are really clunky. And so what most people will do is have that fiat currency on and off ramp where they can get money in and out. But then from there, they just change the cash into a stable coin like USDT. And once you have USDT, you can withdraw that to any other platform like Bybit, Binance, OKX, or your own wallet to trade on a decentralized exchange. And then you send it back to the fiat currency on and off ramp when you actually want to cash out. So that's one way to do things. I'll show you with OKX here. Go to my funding account, press deposit. It says deposit cash. Here's the bank details. In and out really quickly. Now I trade on OKX as well. Kraken is great as an on and off ramp in Western countries. Coinbase is a great on and off ramp, but like I said, way higher fees, and the trading system is dismal compared to Bybit, Binance, OKX. So what I'll do in the description is leave a list of these exchanges below, and then underneath I'll give you the details of which is best for on and off ramping certain currencies. So Bybit may not be the best in your region for on and off ramps, but it might be great for trading. Well, it is great for trading everywhere if you can access it. So all of those details below, but having your fiat currency in an off ramp doesn't mean you have to trade on that platform, especially if fees are higher. And Bybit has some of the lowest fees, along with OKX and Binance, if you can use those as well. But I'll leave all of the details down in the description below. Now I'll show you how to deposit crypto into Bybit. So if you do use a fiat currency on ramp in your region, and that's the best option for you, you've switched it into a stable coin like USDT or USDC. So now you've got crypto dollars. You want to send that into Bybit to go ahead and trade. Or if you have assets in any wallet that you own and you want to send it into Bybit to trade, this is the way to do that. So go and press deposit. So up here, press deposit here. It's going to take you to this. You can also get to this through your assets. Go to the funding account, choose the asset, press deposit. It's the same screen. So I know I've got some USDT over in another exchange, and I'm going to send that into Bybit. So when we are sending and receiving crypto, there's only two things: same asset, same blockchain. That's it. Same asset, same blockchain. So I'm sending USDT from my other account. So I'm going to press USDT. And then from here, it says, which chain do you want to use? So what I'm going to do is go over to the other exchange, and I'm going to make a withdrawal from my exchange. So I've got some USDT in my exchange. This is my Binance. So I'm going to withdraw USDT. So same asset. And then it says withdraw to where? I'm just going to need to make sure that Binance and Bybit can use the same blockchain, because you're sending a message basically between one exchange and the other. And they have to support the same blockchain so that they can send and receive the message. So I'm going to look on Binance and see which blockchains are supported. You can see that BNB Smart Chain is supported. This is Binance's chain, and the fee to send dollars is 0. So I'm definitely going to use that one. And it says, which address do you want to send to? So I'm going to go back over to Bybit, And then from here, we have to make sure that Bybit accept deposits on the BNB chain because that's where it's being sent from. So I go to choose a chain and you can see they accept Ethereum, Tron, Arbitrum, Solana. This one here, BNB Smart Chain. So I'm going to click that. So I know it's the same asset and we can use the same chain. So I can send and receive the message and I'm going to press acknowledge and that's my deposit address. So I'm going to click this and I'm going to copy this address. That's my deposit address for USDT on the BNB Smart Chain. I'm going to go back to Binance. I'm going to copy or paste in this address and it checks everything and says no issues. So I'm sending same asset on the same blockchain. That's my Bybit deposit address here. And I can choose to withdraw any amount. The minimum withdrawal is 10. I've got $4 here. So just to show you, but essentially you're sending that amount over to this address, which is your Bybit deposit address, same asset, same blockchain. Press withdraw if you have it on another platform. That sends it from your platform over to Bybit. Now, you don't have to use BNB Smart Chain. If the other exchange you're using uses another chain, it doesn't matter as long as Bybit accept that. So if you can't use BNB chain, maybe your exchange supports OP Mainnet, Avalanche, Polygon, one of these. Just choose the cheapest one because you're just sending a message from one exchange to another to withdraw from that exchange and deposit into your Bybit account. All the addresses may be different, so just double check everything. Same asset, same blockchain, and you can make a deposit into your Bybit account. If you want to withdraw crypto from Bybit because you want to cash out on a different platform, then you can do that too. Or if you want to hold assets in your own self-custody. So if you've got a hardware wallet, a software wallet or something else where you want to keep the coins, you can withdraw them out of Bybit and put them into your own wallet or to another exchange's wallet. It's all the same. So we go to withdraw. So go to your assets, go to funding account or where you keep your crypto, choose the asset that you want to withdraw out. I'm going to withdraw some USDT. USDC is the same, right? Whatever, it's a US dollar stable coin. You just want to send it out to another exchange. So we're going to press withdraw. And I've got USDT here, so same asset, same blockchain. Now, the chain type here, I know that Binance, I'm going to send to Binance this time. They accept deposits on the Binance Smart Chain or BNB Smart Chain, so I'm going to click this one. Now, if your exchange doesn't support this chain, just make sure that, again, Bybit and the other exchange are using the same blockchain and you won't have any issues. And the same asset here. So I'm going to go over and paste in my address. So I go over to the place where I want to send the assets. This is my deposit address. I am depositing this time USDT, BNB Smart Chain, same asset, same chain. Press copy, that's my deposit address. Go back to Bybit. Then from here, I'm going to paste in the wallet address like this. And that should be verified because I've sent there before. So USDT over the BNB Smart Chain, that's my Binance deposit address. And I'm withdrawing crypto from Bybit this time. Press the amount that you want to go ahead and send out. Now, notice there is a $1 fee when withdrawing through Bybit. That's because we're using a blockchain and Bybit have to pay the fees there. Now, they're probably overcharging us a little bit, but it is what it is. Bybit do have actually pretty good withdrawal fees, so they don't really overcharge here. They usually charge more or less what the blockchain is charging. We have to pay a blockchain fee because the blockchain charges a fee, and Bybit aren't going to pay that for us. So when you do withdraw from Bybit, you can see that fee here. Bybit make it free on their end because they own BNB Smart Chain. Bybit have to charge us $1 here. What you can do is go and search for all of the chains and what they cost. So most of them are $1. Some are free. So the Mantle network is free. Some other exchanges may not support the Mantle network. So choose the cheapest one if you're just sending between exchanges. Now, if you're sending to your own wallet and you've got that set up, then it matters which blockchain that you use because that's where your assets will be held. So assuming that you have a wallet set up and you know which blockchain that you want to hold the assets on. So a good example of that is ETH. So we'll look for ETH here. Down here, I'm going to press withdraw, and you'll see that you can actually use a bunch of different chains. And you're just going to have to choose the one where you actually want to keep those assets. It's too much for this video, but if you have a wallet set up, I'm sure you know where you want to keep the assets. This is, if you're sending to your own wallet, that when you withdraw to that wallet address, it's going to be on that blockchain, which means you can only use that blockchain once the assets are on that blockchain. If you want to switch to a different blockchain, then you can use a bridge in your wallet, or you can send it back into Bybit and then wait for it to settle in Bybit and withdraw it back out into the other network. So let's say I send ETH on Ethereum mainnet, then I've got ETH on Ethereum mainnet and I can use Ethereum mainnet dApps. But let's say I want to take that ETH and send it over to Arbitrum 1, which is a layer 2 on top of Ethereum. It's a bit cheaper. I can use a bridge if I want, on chain, or I can just send the ETH back into Bybit, wait for it to settle, withdraw it over Arbitrum1, basically using Bybit as a bridge in that case. Too much for this video, that goes into blockchains, but just know where you're sending if you're sending it to your own wallet. If you're sending it to another exchange, just use the cheapest blockchain, because you're just sending a message from one exchange to the other. Depending on which fiat currency you have in your Bybit account, you can withdraw that as well. Now, what you can do is trade in the spot market, which I will show you in a second. Trade in and out of fiat currencies and cryptocurrencies that are supported. Once you have a fiat currency in your funding account, which would be here, you can then go ahead and withdraw that. So go to the right hand side and press withdraw, or come up here and press withdraw here. I'll press withdraw up here. It says withdraw cryptos, but we've already seen that. I'll press fiat withdrawal. And if it's supported, you can use the same payment methods. So if you do have some euro in your account or another supported currency, then you can choose these options. Now you can see that there is a small fee here, €2.40, smaller fee for Zen if you have an account with Zen. I don't have any balance here, but again, go and press continue. Then you'll send that payment out. You're gonna have to put your SEPA banking details in here. If you have euros, or if you have another currency, you have to put your currency details in, and that will send out a transfer from Bybit over into your account. So that is how you off-ramp some currencies. Again, not every currency is supported, which is why, what you may have to do is switch it into a stable coin, take that stable coin, withdraw it to another off-ramp in your region, so you can off-ramp it into your fiat currency. Bybit do have a very simple convert feature. So if you go to buy crypto and convert, this lets you swap one currency for another. This includes fiat currency and crypto. So it's easy to use because you just swap the crypto. So let's say I've got some currency here. I'm going to choose USDT, but you can also choose any fiat currencies that you may have. I'll choose to swap all of this, and then I'll swap it into the other currency right here, which is Bitcoin. It gives me an exchange rate. Now it says 0 fee, and then we'll press get a quote. And it says, this is the quote. Do you want to confirm the transaction? Press confirm. You actually swap and convert from this currency to the other currency. I wouldn't recommend doing this. Even though it says 0 fee, there is going to be a spread within the price. Like when you go to the airport and they give you an exchange rate with no fees, but the exchange rate is really wide and not a good exchange rate. That's what this is. And so I wouldn't recommend this. It is simple, but I wouldn't do it. I would go to the actual spot trading market and do it there, because the fees are way lower and you get a proper price for the exchange. But it's easy to do. Now, if you are spending on the Bybit Card, then if you're transacting and having to swap a crypto asset for the fiat currency that you're using to spend the card, then it will use the convert feature, which is a higher exchange rate as well. So something to be aware of, which I'll go over in the card section. But convert is easy. I wouldn't recommend using it. Now we'll look at trading properly in the spot market, the best way to trade. So what I'm going to do is send some assets from my funding account and put it into my trading account so I can go ahead and trade. I've got some USDT. So I'm going to press transfer right here, or you can go up to the top and just press transfer. And I'm going to send it from my funding account into my unified trading. This is the coin that I want to send. I'm going to send that, press confirm. That's an internal transfer between your accounts. So it's free and instant. And that money's now gone into my unified trading account that I can go ahead and use to trade with. If you've never traded before, then I'll quickly explain how trading works. Everything trades in a pair. So you have one of the assets that you want to buy and one of the assets that you're selling in order to buy the other thing. And so that's known as a currency pair. So for me, I'm going to be using USDT. This is a crypto version of the dollar. So it tracks the dollar one for one, essentially. So it's basically like using dollars to go ahead and buy other crypto assets. So you can spend the dollars to buy Bitcoin, or you can sell the Bitcoin to buy dollars when you go in and out of risk. And then you've got the USDT that you hold in your account. And that's basically like dollars in a bank account, but it's crypto in a crypto exchange. And so doesn't matter what you use. You just have to find the pair that you're trading. So up here, this is how you find cryptocurrency trading pairs. I'm in trade and then spot trading right here. And we're going to go ahead and trade. So up in the top left, all you need to do is find the currency pair that you want to trade. Now on Bybit, the two main stable coins are USDT and USDC. These are the top two stable coins in crypto. So this is Tether and this is from Circle. Two big issuers of USD stablecoins. USDe is another one. This is from a much smaller crypto style stablecoin issuer. And this is a different type of stablecoin. So these two, they actually just take dollars or very short-term government debt, which is valued basically as a dollar, keep it in a big account, and then issue these stablecoins against it. So $1 of the stablecoin is basically backed by $1. Or worth of value in US government paper. USDe is different. This runs a completely different strategy where they're doing some kind of hedge fund style trades where they're trying to make sure that they keep their assets around $1. So the risk profile is different. So I'd recommend for ease of use, either USDT or USDC. There's also, of course, other cryptocurrency pairs versus other assets. So you've got euro trading pairs here. So if you're in Europe, you can deposit euros and then just switch those euros directly into a crypto. So you trade the fiat currency trading pair. There's also Brazilian real, looks like Turkish lira, and then you have some other crypto trading pairs as well. So for me, I'm going to press USDT, but if you've deposited some fiat currency that's supported onto the platform, you want to find the fiat currency trading pair. So euro and then Bitcoin. Now look on the right-hand side, this price will change. So right now, I'm looking at the Bitcoin US dollar pair, basically. So we're at 102. I'm going to choose euro, Bitcoin, and you'll see it changes because the exchange rate now is euros to Bitcoin, not dollars to Bitcoin. So just choose the currency pair that you want to trade. I'm going to press USDT Bitcoin, and you can find any currency pair here. So you can search by the ticker of the asset. BTC is Bitcoin. You can see all of the different markets here. ETH, the other ones, right? So these are the spot markets, and this is ETH against USDT, USDC. ETH against Bitcoin. So if you have Bitcoin and you want to sell it to buy ETH, or you have ETH and you want to sell it to buy Bitcoin, you don't have to go through another pair. You can just trade them directly together. ETH Euro and ETH USDe, as you can see here. These are futures and options markets, which I'll show you later in the video. So just choose the asset pair that you want to trade. That is going to give you right here the exchange rate for these two assets. Now I'll show you the spot trading screen and what everything means on here. So all we're looking at is a currency pair and the exchange rate between them. So like I said, you can choose all of these currency pairs up in the top left and choose the currency pair that you want. We'll trade in the spot market for now, and we'll trade futures and perpetuals later. So this is the price chart of the currency pair that you're looking at over time. So what we have, right? We have the base currency and the quote currency. The base currency is on the left and the quote currency is on the right. That means for the base currency, in crypto, we trade units. So 1 unit of a currency. 1 unit of Bitcoin is 1 Bitcoin. 1 unit of Ethereum is 1 Ethereum. For 1 unit, how many of the quote currency does it take to buy that 1 unit? And that's where you get the price quote of $102,588 for 1 unit of Bitcoin. Right, so that's the exchange rate between them. Now that exchange rate fluctuates over time, and this is what we get. We get a chart of that exchange rate. So you can see that it has taken, over the last few weeks or months, it's taking more of the quote currency, it's taking more dollars to buy 1 unit of BTC over time. Now I'm using candlestick chart here. If it isn't candlestick for you, go to this, and I think it's this one right here, sorry, and then go to candles. Candlesticks give traders much more information about the price movements on any given time horizon. And I'll show you candlesticks in a second. But what we can do is choose the time horizon that we're looking at. So I'm choosing the 1 day time horizon right now. This means that the price information is refreshed once per day. One of these candles is 1 day in length. So this candle here is 1 day of price action. And then the next candle is the next day, and the next day, and the next day. Put them all together, and you get this, over time, you can see the price moving. Now, of course, green is up and red is down. I believe you can change the colors here as well if you go to settings, because I know in Asia, I think they have a different color scheme. But for me, I choose a green up, red down. So this is the price chart here, and let's change the time horizon. So I'm going to go to a week chart, and you can see it changes. Now, each of these candlesticks is a week, and you can see that the candle or the chart itself looks different now. Because the price data is 1 week instead of 1 day. But you can see over time, again, we're moving up in the exchange rate, right? So down here on the right-hand side, you can see the price was, this price, and then it moves up to the higher price here, right? So you've got price on the right-hand side and time on the bottom. This is volume down here, so you can see the volume's increasing, the trade volume's increasing as we move up. That's generally pretty bullish and good news. But then we can change this down to the 1 hour as well, and then you can right-click, go reset chart view, and that changes things. It really matters the time horizon that you're looking at. So for the 1 hour chart, right, things could look pretty bearish, right? If you look at the 1 hour chart and you're saying, wow, look how volatile this thing is, this is crazy and it's moving down. But actually you're looking at very short time frames. So each of these candlesticks is 1 hour in length. And you can see it's very volatile and the price looks to be moving up and down a lot, but it's actually going from 109 to 110 to 100, right? Not really that big of a deal. You can't really get any important information out of a 1 hour chart. right? If you're investing, you're looking at the price over time, really you need to be 1 day and up, 1 day, 1 week, something like that is pretty good. And you can see that. And that just gives you a little bit more smoothed out price action with the candles as well. So it shows you a little bit more concrete information about the actual trend, because over a month or a few weeks or a month, the trend's going to be a lot more certain than over 4 hours or 1 hour when you can get this volatility. So that's how the candlestick can be read, and you can change this around as you want. Day traders will be looking at 1 hour or 4 hour charts, and then swing traders, which have positions open a bit longer, maybe going for 1 day, 1 week. Investors, you're just buying the asset because you think it has outperformance over time, and a lot of people don't even look at charts, right? It's like, I like this asset, and as long as the trend is going up, we're all good about that. So what we can do here as well is also add some moving averages to the chart. So go to this. There's lots of indicators here. So I will look for a moving average, and we'll just go for the simple moving average right here. And then you can change this around. What is a moving average? A moving average takes the price of the asset over a certain period of time and plots it. And then it just plots it again and again, and it smooths out the price into a smoothed out line, right? A moving average of the price over a certain time period. So you can change this. So right now we are seeing a 9-period moving average, and I'm on the 1 week chart. So that should be a 9-week moving average. So what we'll do here is change this to a 50-period moving average, and I'm on the 1 week chart. So it's going to give me a 50-week moving average. And so I'm going to press OK, and you should see that the line actually smooths out even more, right? Because I'm looking over a longer time frame and the price is smoothed out over a longer time frame. So what we can see is that the price is in an uptrend because the price is moving up. This is the actual price here that the market's trading. But then this moving average is also very clear, showing us that we had a downtrend and now it's moving up into an uptrend, right? And you can also see that the price itself actually moves away from this trend line. And that's a really good bullish sign, because when the price sells off into the longer term trend, it seems to bounce again and move to the upside, which is a classic uptrend, right? And so you can figure this out. Is the price in a downtrend, in an uptrend, right? This is obviously a very clear, strong uptrend, because whenever the price sells off into the 50-period moving average, that longer term trend, it bounces again. Now, as you can see, it goes below that as well. So it depends on your wider analysis of what the asset's doing, and if it's in a bull market or a bear market. That's some simple charting that you can use, and honestly, that's going to be the majority of what you look at, and it's going to help you out a lot. If you've never used candlestick charts before, I'll quickly show you how they work to give traders a lot more information about what is happening over a period of time. So like I said, 1 hour, 4 hour, 1 day, 1 week, it doesn't matter. That's just a time horizon. And then within that time horizon, there's only 4 things that can happen, right? So the first one is that the price opens. So one day, 12 o'clock, the price opens, and it is a price, right? So you draw a line here, and that is the opening price for that time horizon. During that time horizon, the price can move. And so that is drawn in a line. So you have the open here. That's the time when the time horizon starts. So let's say 12 a.m. on Monday, right? So at the beginning of the day. The price moves up and down, and you draw that as a line. So you have a low price and a high price during that time horizon. You also have a close price because we're looking at a day chart, and so on Tuesday, the Monday chart closes, right? So you have an open, you have a high and a low, and you have a close. And of course, where the open and close is dictates whether the price moved up or down within that time horizon. If it's an up move, I use green, but you may use some other color. Then we go through. The next, so this is Monday, and this is Tuesday, right? So where we close, the next time period has to open pretty much at the same level, right? Because you're looking at a second in time difference. So we close the Monday, we open the Tuesday chart. So we open here, we then get a high and a low during that time horizon, and we get a close. Now, on Monday, we opened here and closed here, which means it was a green candle because the price closed higher than it opened. On Tuesday, we opened here and closed here, which means that it was a down candle because the close was lower than the open and the price moved down. So we just color that in red. Do that over and over again and you get a candlestick chart. I would suggest using TradingView charting software as well and going to set up an account on there. This chart is actually TradingView, they give you this, but it's kind of crushed And the TradingView charting software is much, much better. TradingView is completely free, so you just need to sign up with an email address. I'll link them below as well. There is a pro version. I think you can get a discount via that. But honestly, just try the free version first if you don't have it, because it's enough for most people. But this allows you just a much bigger screen. You get a few more options here as well. And it's just what a lot of people will use to chart the assets that they're trading over the longer term. And then if you're trading in the spot market, you really are just investing over longer periods. And so you will just want to enter your orders on Bybit. So I'll show you what I do with crypto charts very quickly to chart their longer term trends. So go in the top left and right here, choose the asset that you want to trade. I'll show you with BTC, but you can do it with any crypto asset. In the bottom right hand corner, go to logarithmic, and that crushes the price scale. You can see how different this chart looks compared to this, but this is the same asset, it's the same chart. This is showing you the regular price scale, and this is crushing the scale as it gets higher. This is often used for assets that have a lot of growth in them and are essentially in a trend of growth over time. And it just lets you chart that trend a little bit easier. So what I do here for Bitcoin, go to the logarithmic chart, that should give you this asset right, or this chart right here. Now from here, we can go to indicators and moving average again. So moving average simple, and that puts this white line here. I've changed this to the week chart and settings 200 week moving average, right? 200 period, 200 week moving average. This gives me a much longer term outlook of how this asset is moving over time and the trend. The most important thing is the trend. You need to know what the trend is, and that gives you, look, no one can predict the price of anything, what's going to happen or anything, but if you know the general trend, then that's going to make your investing a lot easier, because you know in relation to the trend if the price is pretty high or pretty low, or if you just want to say, hey, look, this trend is actually really good and I just want to invest in it. So from here, what I do is go to the left-hand side, click the curves right here and put these on like this and change them. And I did that with 3 curves. So the first one is in the middle, trying to fit the kind of midline of the curve, so the trend rate. And then the upper bound and lower bound is simply where this price seems to top out at. So you can see up here, we topped out twice at this higher level and then rejected from it. And down here, we seem to be bouncing from that, right? And so that is the upper and lower bound and the mid trend. And then from here, what I did, this moving average, what I did is I plotted the annual rate of return of Bitcoin over 4-year periods, which you can do very easily. You can go to Google search 4-year CAGR of Bitcoin, compound annual growth rate. You can Google search that. I'll actually link a page below where you can see this. It's done for you. So I'll link that below in the description. But from here, right now, as I'm making this video, Bitcoin's CAGR or ARR is around 40%. And I think that's going to come down to like 30% and then 25%. So what I did with the moving average is just plotted out what a 40% ARR would do to the moving average price here over this period, and then this period at 30% and this period at 25%. And that gives me, this can't be perfect, right? It might be wrong. No one knows what's going to happen, but I'm trying to at least give some sort of prediction of where the trend may move to. Now the price can be above that trend, it can be below that trend, right? This is not a prediction. It's just, if you're going to look out into the future, try and predict something here and try and give yourself some sort of idea of where the trend could move to, right? And so that is pretty much all you can do. And these blue lines are simply the Bitcoin halvings right here. And then green, red, and yellow is simply where I thought we were in a bull market, and a big bull market to the upside and then a bear market to the downside over time. So that's how I plot BTC, but you can do it for ETH or Solana or Cardano or any of the assets, or Tesla or NASDAQ index or anything you want. You can do that. And that just shows you if prices are above or below. However, for long-term investors, right? Long-term investors are people that invest some of their income over the long term into the asset once a week or once a month. Well, if you did that once a week, this white line is your cost basis for Bitcoin, because you buy every single week. And so the price that you get for Bitcoin is the same as the moving average of the price over however long you invested for. So if your price for Bitcoin is down here and Bitcoin is currently above it, great news, right? But you invest with, turning some of your assets into the Bitcoin or crypto or NASDAQ or Tesla or Apple or whatever it is you want to invest in. You're investing it because over time you think it's going to outperform the dollars that you're earning or the fiat currency that you're earning. So that's how I try and predict prices over the longer term. And then back in the spot market, Spot market is used for buying and holding assets, so we go ahead and trade them here. Now we can look at the order book and how to enter orders onto the system, either if you're buying or selling one side of the currency pair. So the currency pair that we're trading right now is Bitcoin USDT. And so we have the order book for this currency pair right here. Each currency pair has a different order book with a different price and a different amount of buyers and sellers. Buyers are down here and they are showing their orders to everyone else saying, hey, I'm out here and I want to buy Bitcoin and this is the price that I'm willing to pay. And so the highest bid, that's up here, and these are lower, so these are cheaper. People down here are still trying to buy, but they're bidding lower prices and hence they are down on the order book. The highest bid is this one right here. On the top, you have sellers. And so these people are selling Bitcoin in this instance, and this is the price that they're willing to sell for. This is the cheapest offer, and then these get obviously higher up here. And so they're ordered where the best bid and the best offer are both sides of the order book. The difference between them is known as the spread. So you can see the spread here is between 10 and 11. So there's 1 cent as a spread. It's pretty much the lowest spread you can get, right? So between 10 and 11, now it's 93, 94, 7, 8, etc. Right? So you can see that this spread is very small. The difference between the best buyer and the best or lowest seller. And then when they actually meet and trade, this mid price changes and shows you the last traded price of the currency pair. That's how that works. And it just shows us the prices and the quantity that each price has, and then the total amount. Now, because crypto changes so fast, it really doesn't matter how much you see on here, because algorithms are trading it most of the time and they're not going to show their entire order, and they show a little bit of it and then pull it away and then it trades and changes. So it doesn't really give that much information, to be honest. You can just look at the actual price that you're trading and then you can put trades in around that price. So how do we go ahead and trade? Well, we need some assets in our trading account first. If you don't have that, just go to plus here and then you can transfer from one of your other accounts, your funding account, like I showed you earlier in the video. So I put $100 here so we can go ahead and trade. So how do you actually go ahead and trade? Well, I'm going to show you a market order first, which is like going to the airport and exchanging currency. So you have $100 and you say, I want to get some euros or whatever else. Here's my $100. How much do I get back? Right? So you don't choose the exchange rate. You just choose how much you have and you spend. So on this, what we can do is just choose USDT, order by value. So order by value or order by quantity. Well, I know I've got 100 USDT, so I can just choose order by value and then choose how much USDT that I spend. I can also do order by quantity, and then I have to work out how much Bitcoin do I want to actually go ahead and buy. So if I choose order by quantity, I'm now choosing an amount of Bitcoin that I buy, as you can see here. But this may change over time because the price changes, right? And so if the price changes, that means the amount of money that I'm spending will buy more or less Bitcoin depending on the price. So it's easier if you're just trading from dollars to just do order by value. And then you can say, I'm going to choose $10 or $100, whatever it is, right? You can also slide this around. So if you know you've got a certain amount in your account, you can just slide and put an amount in, right? And that changes the value of your order, how much you're spending. So let's go ahead with the market order. And I'll show you how quick this is. So buy BTC, just confirm everything. And that's it. You bought the BTC because you bought with a market order. And that means you didn't choose the price that you paid. You just choose the amount that you spent. Now with a market order, you go out and you get the best possible price, which is this one down here, right? This is the cheapest seller who's showing us their order and saying, you can buy my Bitcoin at this price. So with the market order, we go and we get this price, whatever that may be. At the current time, and that puts the Bitcoin in our account. You can see I've now got less USDT and I've got that amount of BTC. We can also use limit orders to trade, which is where we choose the amount that we trade and the price that we trade at. And by doing this, we can enter the order book. So choose limit order, and now you see there's a different box here. So we can choose the price that we trade and the amount that we trade. So we are going to choose a price that we trade at. Now, this doesn't mean that you can just trade at that price. It just means that you can enter an order onto the trading system and join everyone else in telling people what you're willing to trade at. So the price currently is $102,000 per 1 unit of Bitcoin, 1 Bitcoin. So I'm going to say that I'm willing to trade at $99,999 per Bitcoin. And I'm going to choose an amount to trade. And it shows me that the price times the quantity is going to spend this many dollars out of my account. And so what I'm doing here is I'm telling the system that I'm willing to trade at this price. but I'm not going to trade because the actual price in the market is higher, meaning there are people above me willing to spend more on Bitcoin than I am, so I can't trade it because no one's going to sell me the Bitcoin at this cheap price when they can sell to someone else at a higher price. So if I press buy BTC, press buy BTC here, I have an open order. The order is open because it hasn't traded yet, but it is in the system. So I'm on the order book down here at 99,999, below all of these people. These are above me. I have my order. You can see the order price. You can see the quantity and the amount that you would spend and the order time. On the right-hand side, you can cancel that out. If you cancel it, then the order cancels out of the system. You haven't traded. You haven't paid any trading fees because you put the instruction in, it didn't trade, and you canceled it out. That was it. So I can change the order price here, and let's change it to, you know, something like that or whatever, right? You can change it to 101,000, so I'm much closer to the current price. So I can leave that order in, and it's known as GTC, which is good till cancelled. You can see that just above my head. Good till cancelled means that this order is good in the system until I physically cancel it. There's no time limit or anything like that. If I choose this, just above me, you can see there's good till cancelled, GTC. Immediate or cancel means if you can't trade this order that I put in immediately, then cancel it. So if I put that 99,000 order, 999, order in, and it couldn't trade, it would actually cancel the order out and not have it in the system. And fill or kill means trade the order in its entirety, or if you can't, kill the entire order. Just leave it on good till cancelled. This is a massive market and you can do pretty much any amount of size. So those orders are pretty irrelevant for very, very large assets. If you're trading a tiny asset with very low volume, where your trade may move the market and it can't trade at that price, then you may want to use those order types. For the big assets, they trade tens of billions a day, so we're not going to move the market with anything, right? So this is in the system because it's good till cancelled. On the right-hand side, I can press cancel. That cancels out the order. That order isn't open anymore and I haven't traded. But if you do trade, go to your trade history here. That will show you all of the trades I've executed over time. Bybit may give you certain trading fee discounts if you are a maker of liquidity. So what is maker versus taker? You see the market order. We are a taker of liquidity because our market order took someone else's order out the order book. They showed the order, they offered the Bitcoin out, and they showed the price. They made liquidity on the order book. We took it out when we took our market order. So we are a taker of liquidity. We may pay slightly higher trading fees with taker orders. A maker is where you use a limit order and you go and choose the price away from the price and you make liquidity onto the book. You show your order, you show your size and what you want to trade. You make liquidity there. If you trade from a market order that you showed, someone else is taking your liquidity. So you're a maker and you may get slightly cheaper trading fees. The difference is basically irrelevant in the trading fees, but there is sometimes a slight difference between maker and taker, with some exchanges trying to incentivize you to put limit orders in the book and show liquidity. So that's a limit order. So that limit order I put in, I didn't trade. So what I often do when I buy is use limit orders and I just come down, I see the price and I say, okay, the price is 102,267. So, I'm going to trade at 102,230. The reason being is that I can buy some here. The price is a little bit lower than the current price. And you can see the price moves around like this a lot, right? And so the chances of me getting hit buying here at a little bit lower price are pretty high. So I just get a slightly better price. I'm a maker of liquidity and I put my limit in there and slightly cheaper fees, maybe a slightly better price over time. Again, pretty irrelevant, but hey, it's a small difference that just gets you a slightly better trade, for what you're doing. So that's how to use limit orders. I'll also show you the sell side, which is the exact same thing, but opposite. So if you are selling, now what we're doing is selling Bitcoin USDT. So down here, it says sell Bitcoin, right? So we know we're selling BTC. So again, you put an amount in here that you have. I just bought that Bitcoin. You put the order price in, so I'm going to choose limit order. Now, because I'm selling, my limit order should go above the current price. So let's do 105,000. So I can put this quantity in that I'm selling. Let's sell that whole amount. I press sell BTC, confirm, and the order goes in. And again, my price is too high this time, so I can't sell because there are people selling at cheaper prices than me. So you can do exactly the same thing. You can change the order price or the quantity, and I'm going to cancel this out. And if I put the sell order in at a price that was below the current price, I'd actually be selling a market order. So for buying and selling, if you're putting a limit order in, so let's say my buy price is 200,000. And what I'm saying to the system is buy immediately right now as long as the price is 200,000 or better. Well, it is, it's 102,000. So my order is going in basically as a market order at that point. So I pay taker trading fees and I'm using a market order and I'm just buying immediately. And so you may not want to do that. And obviously if you make a mistake, then that's an issue. On the sell side, it's the same thing, where if you put your sell order in at 50,000, right, then it would sell immediately like a market order. The way that you prevent this from happening is going down here and pressing post only. What this does is it prevents an order as a limit order going in like a market order. So let's say I say sell and I actually, like this, instead of putting 120,000, I miss out a 0 and I say 12,000. That is going to sell immediately, right? And that's a mistake. Well, post only prevents that happening because this would go in as a market order straight away and trade straight away. And I don't want that to happen. Post only is going to prevent that happening, where this only executes as long as your order can go in as a limit order, which means that it can't go in at or below the price on a sell side. And on the buy side, it's the same thing. If I say 102 and I put an extra 0 in, which is going to execute my order immediately to the buy side because I made a mistake, post only is going to prevent me from doing that, and it's going to cancel the order out and make sure that I don't make that mistake. So post only can help if you are prone to making mistakes and you're putting your numbers in. Now we'll look at the different order types that we can trade on Bybit or any trading system, which is the drop down box right here where it says TPSL, and then you have these different order types. So TPSL stands for take profit, stop loss. And these are specific orders that we can put in to either take a profit or stop a loss. And so this is an important order type. It's also known as a conditional order or sometimes a trigger order. You can actually see with TPSL, and if I press conditional, nothing changes here. This is the exact same order type. They have it twice. I don't know why, but you can either use TPSL or conditional, otherwise known as a trigger order. You can see the trigger price right here. So it's a step away from limit orders. So limit orders are great because if we're a buyer, we can put a limit price below the current price, try and buy some cheaper crypto, and if we get met with a seller in that case, we buy. The thing with the buy a limit order buy is that if we put our price on the limit order above the current price, it just goes through immediately as a market order, right? Same for the sell side. You can sell and you can put a higher price in and wait. And that's like a sell order or a take profit order, right? Because if I've bought Bitcoin at 50 and I want to sell it at 200, I just go sell, limit order, put my order in at 200,000, press sell BTC and I wait. But if you press sell and then the price is 80,000 below this current price, it sells immediately. So if we want to sell below the current price, but not right now, right? How do we do that? And that's what's known as a stop loss. So these conditional orders, or take profit, stop loss, and conditional or trigger orders, in the spot market, they're really only relevant for stopping losses because you have to buy the asset first in order to then sell it and stop a loss that you may be making in the asset. And why this needs a conditional or a trigger order is because if I put a limit order in and I say, look, I've got 1 Bitcoin and I've got in 104K and I want to sell out at a loss if it gets down to 87K because I'm afraid of it going even lower. And so I want to stop a loss by selling out at a loss, right? So you lose 20% or whatever it is, and you prevent potentially losing 30, 40, 50% in the position. So that's what these trigger orders are for in the spot market. So what we'll do is we'll press conditional or TPSL. They're both the same. And this order requires a trigger price. So this trigger price means that the order will only go into the system and start trading when that trigger price is met. So trigger price, I'm going to put 80,000 and I'm just going to use a market order for that trigger, right? So what I'm saying to the system is at 80,000, input, because once the trigger is met, input my sell order, and I'm going to sell at a market order, which means I'll sell at any price when the order goes in. You can also change that to a limit order, which means at the trigger price of 80,000, only at that trigger price, then enter my limit order to sell at 80,000. And so that limit order goes in and you have an amount to sell at 80,000. Now that limit order can be anything you want as well, right? Because this can be, let's say 150,000. Now what would happen there? So only at 80,000 is the trigger that the limit order goes in and your limit price is 150,000. So because the trigger has triggered, the price has to be at 80,000 now, and your limit for selling is 150,000. So the order will go into the system, but it won't trade because your price is too high because it got triggered at 80,000. And so you can put this 80,000, you can put this 70,000 or whatever you want. For trigger orders, most people are just going to use a market and just say, look, at 80,000, this is a trigger to sell my Bitcoin at a loss from the current price to prevent further losses. So a trigger order only puts your order in. This is the order that you're making at a price that is triggered. This is something that you can do for a stop loss in the spot market, selling at a price below the current price at a loss to prevent further losses. And you can't use a limit order for this because if you put a limit order in at 80,000, you'd sell immediately because it's 104,000 right now. So a trigger order in the spot market is for selling usually, because you have to buy the asset first and then you would obviously be in the position and taking a loss. So that's what a trigger order is. Now the take profit part, you can also do here as well. So I'm going to do a market order, and let's say I want to sell and my trigger price is 200,000 and I'm going to sell some amount of Bitcoin, right? So what that is now going to do is only input my sell order at 200,000. However, in the spot market, because you already own the Bitcoin, in this case, you may as well just use a limit order because you're above the price, and so it's not going to trade until it gets there. So really in the spot market, triggers are only for stop losses if you want to sell below the current price. But when you're trading futures and taking long and short positions, you can have those stops above and below the price depending on your position. The next order type is OCO. This stands for one cancels the other. And this one will just toggle on right now, OCO. And so this is a order type where you can enter the same type of order either below and above the current price. And so this is really used when the price is within a range and you want to do something at either end of the range. So I'll quickly show you on the chart here. I'll just draw some lines on right here. So what you do to draw lines, you just click it on and then click to finish. Now on my keyboard, if I press shift, it creates a perfectly horizontal line, right? So I can draw them any way around. If I press shift, it basically draws it perfectly straight. So you can do that if you like. I'll just delete that one. Then I can copy paste this one and put it down onto this range. So this is a range right here, right? And so let's say you're in the middle of the range and you don't want to buy the middle of the range. You either want to buy the support, right? This bottom line here is support because you can see we're bouncing off it. Price is coming in, bounces off, bounces off, bounces off. So you don't want to buy at the middle of the range, but if you get down to this bottom end of the range, you want to buy that. So you want to tell the system, hey, buy the bottom of the range for me. However, you don't know if you're going to get down there. And so you may also want to put an order in up here at the top of the range. And why would you want to do that? So as a trader, there's a range that you can see happening. And you want to buy the bottom of the range if you get down there because you think it may have support there and bounce higher. But if it doesn't, then it's going to break out of the range to the upside, and you also want to buy that because a short-term trade, you maybe want to buy here because if it's breaking out, it may go way higher, and it did, right? So you wanted to, let's say you're in the middle here and you think, you know what, we may actually break out, we may come back down to the bottom. So you want to buy this if it gets there, but if it doesn't, you also want to buy this. And so you can do that with an OCO. One cancels the other, meaning that once one of those orders is hit, the other one cancels out. So we can put this in here as an example. So this was the range. Let's say we're at 62,000 and you either want to buy 53,000 or you want to buy 73,000. Take profit and stop loss here is slightly misleading. Essentially, this top one is the bottom end of the range that you want to buy, the lower price. This one up here is the higher price that you want to buy. So let's say I want to buy, my trigger price for the lower price would be, let's say this price here. So yeah, 55,000, right? Something like that. And I just want to do a market order here. Now for the stop loss, that's the higher price. So let's say up here at the top of the range, 73,000. And then I put the amount in that I want to trade on either of those orders. And these are both market orders that I'll place there. So these are both triggers. And the OCO is essentially when one of those is hit, then we will go ahead and buy the Bitcoin and the other one will cancel out. And that's good for range trading. If you either want to buy the bottom or the top of a range, wait for that to happen. Now, if you put a limit order in here, you can do that with a limit order. And if you put a trigger order in up here, because you can't use a limit order to buy if the price is down here because it would trade immediately. So up here, you might put a trigger order in. So you could do that. However, you would have to take the amount of money that you need to actually execute those orders and tie that money up in both of those orders, right? Because you have to have two separate orders. So each of those would tie the money up. Now, you may not have that, or you may want to choose to trade all of your money. And so you would use an OCO because you can just tie up the money once, and whichever one of these trades, it cancels out the other one. The next type of order we can use is an iceberg order. I tended to use these a little bit when I was trading for my firms. If we had, a fairly larger order, you didn't want to do the whole thing in one go. So iceberg, this takes you through to the tools section right here. So you can actually get to that here as well. So if we go back, these are the different tools, but you can get to them either through tools or through trade, and then just right here. So an iceberg, it's, it is what it sounds like, which is there is an iceberg here. Usually there's a water level, right? And then you have the iceberg tip, and then you have this huge iceberg underneath. So essentially what we're doing is showing the market this tiny bit of the order, and so that they can see that. But then we have the bigger order under here that we're trading as well, and telling the system that we're going to do that. Usually either buys or sells can work fine for this. I used to use them with sales because you don't want to spook the market with a big order. Again, if you're trading any amount, that's fine. It doesn't matter, right? Huge orders may move the market. Not for Bitcoin. We're never going to move the Bitcoin market. It's a massive market. But if you do have a bigger order, you might just want to space it out over time. So iceberg, show a little bit. And then each time you trade that, then you trade that out. And then you refresh the tip of the iceberg. So total quantity, I've got some BTC that I want to sell. The order is something like this. Let's do 0.1. Okay, so I've basically split this amount of Bitcoin into tenths. And so you're splitting the iceberg into 10 different orders. And you can do your order preferences here. Faster execution, better execution, or fixed prices. It's up to you. And then we'll go down to price limit. We obviously want to set the price limit here. So let's do 103, something like that. So what we're saying to this system is, I have this total quantity to sell. I want to split it up into 10 different splits like this. You can either choose the quantity per order or the number of split orders. So if you don't want to divide the amount you're selling yourself, just say, well, I've got 10 Bitcoin, please split it up into 1,000 orders or whatever it is, right? You can choose that. And then choose your order preference and then choose the absolute limit that you want to sell. So anything better than that is just going to do this, show the order. If it trades, refresh every time it trades. But if it goes to 100 or below 103,000, it won't refresh the order anymore. This is for big orders where you don't want to spook the market. A big order is a size that is bigger than what is currently shown on the bid offer right here. So 0.5 on the offer, 0.4 on the bid. If you're trading a lot more than that, then you don't want to move the market and you just want to show it with an iceberg. Now I'll show you TWAP orders. This stands for time weighted average price. Again, this is an order where you have a lot to trade and you just want to feed the price in over time. You can get to it via here, TWAP, or you can go to tools, TWAP here as well. So time weighted average price, we have an amount of Bitcoin, so we're going to sell that. You can do this for the buy side as well. I'll just show you on the sell side. Running time, let's do 23 hours and 5 minutes. And the frequency here, every 30 seconds, every 60 seconds, every 15 seconds, anything like that. So let's do an hour, right? An hour and let's say 25 minutes. And the frequency every 30 seconds. And then the quantity per sub order is going to tell you here. It's just going to work that out for you. So what this does is try to get a trade price for your order that is the time weighted average price. So what the market trades as an average price over an hour and 25 minutes, that should be the price that you get. So that just hopes to spread out your orders a little bit if you're trading big orders. So if you're trying to get into an asset and you've got $20,000 to buy, you can buy that all in one clip, or you can say to the system, I want to buy 20,000 today. just feed it in over time. And then whatever the trading price on average was today, that's what I'll get as well. Scaled orders are pretty much the same sort of thing where you're trying to get a decent price for the asset. So we'll go to scaled order here. And this probably works better for the sell side, but you can do it for the buy side as well. So we'll do the price range here. Price range usually starts at the current price or near to it. And then the price range here on the sell side, let's say we want to sell a little bit higher. So we're selling from the current price and we just want to feed some prices in up. Like hopefully you sell here, hopefully the price moves up a bit and you kind of sell into some strength, right? So we'll sell the amount of Bitcoin here and it says how many orders do you want to execute? So let's do 5 here. And then you can see it just moves up, right? So we have the lower bound and then that moves up from what you're trading. Let's say 20 orders and then obviously 5% of the order each will be in here at different prices all the way up. So that's essentially just trying to hopefully scale your order in at higher prices and get a little bit higher price rather than selling everything at once. So scaled order, choose the amount of orders, choose the price that you want to sell between, hopefully from here and a little bit higher, and then hopefully all or some of them get done over time. Bybit also gives us a couple of tools to auto invest as well if you want to do that. So rather than each and every time that you want to buy actually coming back to the platform, you can automate this. So one of these is the auto invest feature, which is in the buy crypto option. And if you just come into buy crypto and then up here it says auto invest, this is a way to invest at a set frequency. So let's say that I want to buy Bitcoin once a week. I will go to auto invest. I want to receive Bitcoin. I want to pay any amount. And I'm going to choose any one of these, either stable coins like USDT or USDC, or if you have a fiat currency on the platform that you've put in. A lot of people may want to put these fiat currencies on. And if you have the fiat there, just do fiat right into the asset. And then that will do a set frequency for you. Daily, weekly, you can choose. Now, I don't know what the trading fees are for auto invest, but I would assume they are maybe like the convert trading fees. And so you may be paying slightly higher trading fees here. I would just log in once a week and buy it in the spot market because you're getting the best trade and the best fees there. So that's what I would do. There is another way to do this though, which is through the trading bots. So if you go to tools and trading bots here, this one, so click on that, it takes you through to this main page. Down here, you can see the different bots. I'll go through these in the bot section, but this one right here is called DCA. So we'll click that. It takes us through to this page. DCA is dollar cost average, which is where you invest over the long term at set intervals or any interval that you want, and you're just cost averaging into the asset. So you're buying some high, some low, doesn't really matter. You're just trying to get a price over a very long period of time. So we will have some USDT right here, and we want to buy Bitcoin, and let's say we add some as well. So let's say I want to buy ETH as well, and we'll just do that. So press confirm. Now what you can do is choose your dollar cost averaging, right? So we're putting $100 or 100 USDT in each of these assets over set frequency. So the total investment each time is 200 USDT. We can add more cryptos here. Let's say I want to invest once a week, and that money will be in my funding account. So you need the money in your funding account, and then it goes ahead and buys these two, and you can see the max investment over time. So let's say I want my max investment to be 1,000. So it's going to buy for 5 weeks and reach that 1,000 and then end the DCA bot. You can also, once you have the DCA bot created, you can also cancel that out if you want. So if you go back to your DCA bot, it will show you the running bots right here. And if you don't want it to, buy anymore, you can just cancel it out, cancel all the orders out. Again, I don't know what the trading fees are on this because it doesn't tell you. I don't know if it's going to the spot market or not. And so again, I would just, log in for like 3 minutes on a Monday or something, just press trade and go ahead and do it yourself. But if you really don't want to do that, you can set up automated bots to just buy over time consistently. Bybit also have a fairly big launch pool and incentives program for various different tokens. They have this under Spot X. So trade Spot X down here. So this happens on a lot of different platforms, and usually what happens is you get a project that is either launching on the exchange for the first time or is actually launching the tokens brand new to go ahead and start trading. And there's a few different ways that this works, so I'll explain them. One is launch pool. Launch pools typically give tokens out for free, but you have to lock up another token to do so. So many tokens do this when they launch on the big exchanges. They want to get attention for their token launch, and they want to incentivize trading and liquidity of the token. And so what they do is when they launch on the platform, they need to tell everyone. And the way they do that is just letting some tokens go to the people that are trading. And the way that you get the tokens usually is by locking up a set of tokens for a period of time. So right here on Bybit, this launch pool, which is currently active, what you have to do is you have to tie up your asset for a period of time in the launch pool. So there's USDT right here. There's BB Sol, which is the staking version of Sol. And then you have the SOSO, which is probably this token if people have that from either a DEX or maybe some people have it from the team or something like that, and they can lock up here as well. So usually in launch pools, you don't put any tokens at risk. So essentially, as long as you have one of these 3 tokens, you can lock it up in the pool for a certain period of time. And then when the pool finishes and unlocks, you get those tokens back, plus some of the incentive token, which in this case is this one right here. And so there's no exchange happening, there's no risk happening or investment. It's just you lock up and hopefully you get some tokens back. Now, once you have those tokens in your account, they actually get put into your account and you can do anything you want with them. You can keep them, or you can literally just sell out and trade them straight away. And you basically made some money from that launch pool without risking any of these assets, because you're not swapping the assets or buying this one. And so there may be, it says an APR, but essentially it's like they're launching, here's some incentive, lock up your token for a bit, they'll give you some free tokens. You can sell them on the first day, whatever you want. So that's that. And you can see the launch pools down here. Now, if we scroll down to launch pad, that is something different. So there should be launch pad somewhere here, launch pad right here. So what a launch pad is when you are actually investing in this new token. So they're coming to the exchange and they're saying, we actually want your money. We need your money to fund our project. Give us your money and we'll give you our token. And a launch pad is you swapping your token. So for here, you have USDT, a lottery supported in USDT, which is you lock up an amount of USDT because you want to buy those tokens. When they launch, a fair price based on supply and demand, maybe, is given to you. You swap your USDT and you get rid of it and you buy these new tokens and you get them. Now, what usually happens is that they try and launch the launchpad where if you subscribed, your price should hopefully be slightly lower than the current price that it trades at when it comes to market. It's basically like investment banking, like JP Morgan or anything, where what I used to do this as well, you would bring clients and say, look, we've got XYZ company that wants to raise money. They're selling equity. Do you want to buy their equity? They say, yep, I'll give you some dollars or pounds or whatever it was at the time. Put the money in and I'll buy the securities, equity, and give me the equity. Now, the supply and demand here, hopefully those people that bought in the direct equity, they hopefully are in at a price where the demand is such that it pushes the market price up when the project launches, and you hope to, you can sell out straight away for a bit of a profit, or if you like the company, you can just keep it. But you're buying the new tokens in, and there's risk here because yes, hopefully you can sell quickly to make a bit of profit, or hopefully you can get out to break even if you want to sell. But sometimes because you've bought these tokens, they may just not go up and then they go down, and then you've sat in a token where you've bought in at a higher price. So there is risk for launch pads. For launch pools, that's just tokens in your account. There's also some other options we can use within Spot X, like airdrop funds and token splash. These are just incentives to either deposit or trade certain assets, or trade a certain amount, and they'll give you some sort of incentive to do that. I think they're just trying to get trade volume for those assets, but mainly launch pool and launch pad are going to be the ones. Launch pad, you risk assets and buy the new token. Launch pool, you should be getting that token as an incentive, and you have to lock up a set of other tokens. I'll show you how to use Bybit Earn, which lets us earn yield on various different crypto assets like Bitcoin, stable coins, ETH, some other altcoins. Basically, there's 3 ways to do this. One is lending. So you lend your asset out, someone pays you an interest for that. There's staking, which is where you stake a crypto asset on the blockchain and you receive a percentage of the fees paid on that blockchain and the staking rewards as well if there's any inflation. So you get some yield back from the blockchain there. So that's not lending, you're just staking on the blockchain and receiving a portion of fees and token inflation. The third one is wealth management, which Bybit actually carries out this fairly simple arbitrage between their spot and futures markets. And so you put the money in and they carry that out for you. Let's start with Bybit savings, which is essentially lending. So you have an asset, you put it on Bybit and you lend it to someone. They borrow it from you and they pay you an interest for that. And then at the end of the term, they return the asset back. That's how it should work anyway. And Bybit sit in the middle. You go to finance and then earn. And then down here, you can see which assets you can actually use in savings. So I'll check for Bitcoin here. Flexible savings is available. So that means flexible, the interest rate and the time horizon are both flexible, which means you can put assets in and then take them out whenever you want. If there's a fixed term, let's say that's 30, 60, 90 days. As you can see, wealth management has a fixed term of 30 days. You have to tie that money up for 30 days and you can't take it out. Now, there may be some of these products where you can take it out early, but you forfeit the interest as well. So you'll have to figure out exactly, but I'll show you here, flexible savings and the interest rate, the APR is 2.5%. That means that the annual rate is 2.5. So if you only have it in there for a month, you're not going to earn 2.5%. It's 2.5% as an annual rate. And then obviously you have to figure out how much you could make on your stack if you only invest for a month or a week or something like that. So let's go ahead and press buy now, and we can figure this out. So this is BTC, this is the APR, flexible, stake now, and then we'll put an amount in like this, and we can see that we're in this bracket right here. So we get 2.5%, and you can see that the daily yield that you make, you can put auto savings on as well, which is where if you do have any Bitcoin in your account, it just automatically goes over to the savings and it's gonna be lent out on the platform. Flexible, so you can bring it back whenever you want. You have to agree to the terms and conditions. And then you can see up here the stake date. This is when the yield starts and the yield accrual time, etc. So that's your distribution time as well. So that's flexible savings. So you can go ahead, press stake now, and that will stake and go into your flexible savings. Now from there, because this is flexible, you can just go into your flexible savings and take it out as well if you need to. If you have the Bybit card and maybe you have some stable coins to pay for things with the Bybit card, then you can put those stable coins in flexible savings as well. And they're actually spent, when you spend on the card, they're spent out of flexible savings. So as an example, I do this with USDC. I've got some in there on the card. We can go to flexible savings. Current yield is 9.8% for under $500. Above $500 is 4.81%. So press buy now. And I've got flexible savings turned on actually, but we'll press stake now here. And you can see that I've already got auto savings turned on. So any USDC in my account, that just goes over to flexible savings. And then if I spend on the Bybit card, which I have, it just comes out of flexible savings immediately. So if you've got some in there, maybe I've got some amount in here now. So that's gonna just go straight over flexible savings. That goes once a day auto into flexible savings for me. And you can see the real APR changes over time. Remember, this is flexible. So the interest rate can go up or down depending on the demand for borrowing from other people that want to borrow and that pay an interest. So you can see this is flexible over time, but I use this for USDC where I just put some in there to spend on the card. And if I'm going to spend it on the card anyway, then I may have it in flexible savings and it just comes straight out of flexible savings. There's really two main risks of doing this on a centralized platform. So the first is the people that you lend the money to make massive trading losses and can't pay it back. Now that's very, very, very unlikely on Bybit, because when you trade on Bybit and borrow assets, you actually have to put collateral on the system to pay for any potential losses. And so if losses occur for those traders, they actually should get liquidated, which means that they can't have a bad debt, which means they will always pay you back. Now, that system has worked really well for Bybit. I've never heard of any bad losses, anything happening over the many years, but it is a potential that you may have to worry about. If that does happen, Bybit do have a big fund, a security fund for that eventuality, which they would use, and that would be used to make sure that everyone gets whole. But that is a potential risk, even if it's very, very small. The other is, this is for everything, is that Bybit is a centralized platform, so you just have to trust that they're going to be around and not do anything crazy. Now, I've used Bybit for years, and I have money on here and trade on here, and they've been around through a few bear markets, and so I think that risk is extremely low, but it is potential. You have to be aware of it when using these platforms. Now we'll move on to USDe, which is a stablecoin that Bybit supports and pays some yield. So if you have stablecoins in your account, do you want to switch them from USDT or USDC into USDe? I'll explain how this works. This is from Athena. Athena is a project on the Ethereum blockchain, but they run this strategy on, I think, some centralized exchanges. This strategy is known as a delta neutral arbitrage that they're making this dollar stablecoin with. This is different to US dollar Tether, which just takes the cash, puts it in an account at Cantor Fitzgerald, buys some ultra short-term government paper. So you've got basically one-for-one backing dollar and stablecoin. This isn't that. What these guys do is carry out a fairly well-used hedge fund strategy known as delta neutral arbitrage. Sounds complex, but it's actually pretty simple. They take money, and then they go and buy Ethereum and Bitcoin. then so they're long Ethereum and Bitcoin. And that's not good because you have a dollar liability from you that gave them the money and this thing's going up and down in price. That's not good. So the delta neutral part is where they take a complete opposing side of the trade as well in the futures market. So they're long spot and short the exact same amount in the futures market, which means that if the price goes up, one wins and one loses. If the price goes down, one wins and one loses. But the amount of cash in the trade should be exactly the same because each side of the position nets out. So if they've got $1 billion in assets or dollars given to them, it should mean that whatever the price does, they still have $1 billion. And so that's the dollar that they can give back to you. So they have dollar liabilities to you because you have the call on the amount of dollars you gave them. Their strategy should mean that if the dollars are called back, they are able to pay them back. And the reason they pay a yield on it is because the short side of the trade in the futures market in crypto usually pays funding fees. And so they collect those funding fees and pass them back to the stablecoin. That's how it should work. Now, there are some risks here, right? Maybe they mismanage the strategy. Maybe a centralized exchange blows up or something happens. Maybe there's a huge run on the stablecoin and they can't get out of the strategy fast enough. And then there's a depeg. All of that can happen. It can happen with USDT as well, but the risk is a bit lower because no one's going to get a run on the bank because they have the dollars there, right? So there is slightly more risk here of depegging a little bit or short-term volatility of lots of people trying to get out and you want to get out at the same time, so you have to take a little bit of a drawdown. So that's kind of the risk here with USDe versus USDT or USDC, I think, although they've had them as well, right, in the past. But you get this yield on top. So if you just want to hold a stable coin with 10% yield, you can do that. So get USDe. I can switch USDT into USDe, no problem, right? And you can see the exchange rate is, more or less $1 as it should be. And so you have USDe and you're getting that 10%. Now, the other thing is that you can actually use USDe as collateral to trade with. So we'll go to Unified Trading Account and I'll search for USDe and you can see that you can use it as collateral. So if you do trade futures, you know that you put collateral on the system to trade with when you trade futures. What collateral do you want to use? Most people use USDT. Well, maybe you want to use USDe and you're actually getting 10% on top as well, whilst the collateral is in the trade and you're trading on top of that. So maybe you want to use it or not. There are some extra risks, I think, but there's also that yield. So it's an option for people using Bybit. Now we'll move to on-chain earn, which is staking crypto. So there are a couple of assets supported right now. And not every crypto is proof of stake. For example, Bitcoin isn't. And so you can't do this with Bitcoin because you can't stake Bitcoin. But most other blockchains are proof of stake, which means that it's a blockchain and it charges fees when people transact. You can buy the asset, you can stake it on the blockchain, and then a portion of those fees that users pay for using the network come back to you, a bit like a dividend from the network. And so the assets that are supported right now as making this video are ETH, Solana, and Sway. Or Sui, or however you call it. So for ETH, you can have some ETH on the platform and switch it into one of the staking assets. I think most people know how to do this now, right? So you can see the estimated APR right here. It is flexible because you can stake it and unstake it when you want. However, there is a small redeem period of a couple of days where you may not earn any yield whilst you're unstaking. But if we press stake now, and you can choose the provider. Now, Lido is the biggest staking provider for Ethereum. It's a separate company. What Bybit are doing here is they're taking your ETH and they're staking it on the blockchain with Lido. And Bybit are just passing the yield back to you. So if you can go ahead and stake this with Lido yourself on the Ethereum blockchain. You need a crypto wallet. You need to stake it there. You need to know how to do that. You need to pay gas fees on the Ethereum chain and all of that. Bybit do all of that for you. So you put your ETH, and they pass the yield back. They stake it, they do all the blockchain stuff and just pass it back to you. So they're just making it easy, and you're earning right now 3.34% on your ETH, and you get staked ETH as the asset. Mantle also do this, and Mantle is Bybit's on-chain division kind of thing. So they have their own blockchain. They call it Mantle ETH, but it's the same thing. They go and stake on the blockchain, they run validators, they get some of the fees and staking rewards and pass them back to you. You can see that the APRs are pretty much almost the same. Actually, Mantle's is a little bit higher right now. Then we also have CM ETH, which is a little bit different, and you can see they have a bonus APR on that right now. Mantle, this one right here, which is CM ETH, this is a restaking asset. So we have staking on the blockchain, But there's also, there's other blockchains that want to use the Ethereum blockchain, and they pay fees as well. And you can stake your ETH with them. So you're getting blockchain rewards from Ethereum, and you're getting blockchain rewards from these other networks that pay. It's known as restaking, but just think of it as earning yield from Ethereum and from these other networks that also want to pay fees. So you're staking across all of those networks as well. And at the moment, you've got a bonus APR here of 9.75%. So let's go ahead and stake now. We'll choose Lido, and you can see if you have some ETH, you can choose an amount. The minimum is 0.1. It turns it into ST ETH on the platform, which is 1 for 1. So you get 1 for 1, swap ETH into staked ETH. You're going to get 3% yearly on this, and you can stake that amount, and that just goes into your account. Now, again, with staked ETH, this will be an asset in your funding account, and the yield is just paid back to you over time in more staked ETH. So the amount of staked ETH you have should appreciate with the yield that you're getting, right? So that's how they pay the yield to you. If you want to redeem that, you can. You just go into your account, you say, I want to redeem staked ETH. Staked ETH turns back into ETH for you. Or what you can do is trade out of it. So we can go to trade, spot. I'm going to just go to this market here, and then we'll see how to trade out of it. Go to the market for staked ETH, ST ETH, should be this one here. So if you've got staked ETH, you can sell out of it for USDT, fiat currency like euros. So you can just trade out. You don't have to wait for it to redeem or anything like that. You can just trade out, get your dollars, and then you can use your dollars or euros, whatever you want, to do whatever you want with them. So that's how you trade out of it. So we'll go back to this one right here, and it's the same for SOL as well. So what we're doing with SOL, we have somewhere to stake it. You can stake on the Solana blockchain, BB Sol or Bybit Sol. This is, again, same thing. They go ahead and stake it. They give you this token that's liquid that you can buy or sell and trade. But if you have it in your account, you're earning the yield from the blockchain. So you can choose whichever one that you want to get involved with. You need some Sol initially. You can switch that Sol into BB Sol and you're getting the yield. Or if you don't want BB Sol, you can just do it directly on the blockchain, either one of these. But BB Sol is a liquid asset where you can have it in your account, earn the yield, and you can trade in and out if you want as well. Same for Sway. So what are you doing here? You're just staking, you're getting those fees from the blockchain. You can get in, you can redeem whenever you want, or just keep them in your account, and you can trade them as well if they're available on the Bybit spot market. Now we'll look at Bybit Wealth Management, which, as far as I know, looking at all of the documents and everything here, they're carrying out the delta neutral arbitrage strategy, the same one that I described to you that Athena was doing. Bybit run the exchange, and so they have a separate division here which buys in the spot market, sells in the futures market, and then makes a yield out of the futures funding that is paid by traders. And so what they hope to do is earn some of that yield. And so let's look at, let's say, premium. Now, if you're a VIP, you do get better rates for wealth management, I think. And you get some other benefits as well, right? Lower trading fees, better rates on loans, etc. Like I said at the start of the video. So with this, let's go over and tie up USDT for 60 days, and let's get a quote. They're quoting 6% yield on that. That's 6% annual yield, not over 60 days. But you can put an amount in here, and what they will be doing is carrying out that arbitrage strategy for you. So an investment of USDT, 60 days, you get the 6% as they're carrying that out. Again, the risks are that the trade is mismanaged, centralization risk of a centralized platform. Is something going to go wrong? There is some risk here in all of that, right? So you have to figure out if the yield that you're getting is worth you tying up the money and putting it on the platform. That's up to the individual to choose. But that's how this works. From what I read, if we go down here, it says, how is the APR generated? It says they're generated using advanced trading strategies in the Bybit derivatives spot market. And that's what tells me that it's the derivatives spot delta neutral arbitrage that they're carrying out, which is the same as what Athena is doing. So again, there's some risk around this, but that's what the wealth management is. You have an amount that you put in, and then obviously you get some yield on it. There's other products within Bybit Earn that we can also get into, which is on the right-hand side here under advanced. So I've shown you the simple ways really, which is lending your money out, on-chain earn, which is staking, receiving fee revenue, and then wealth management. If you want Bybit to do that, hedge fund strategy and pass some of the yield back to you, you can do that. As we get into any of these are Bybit's attempt at simplifying very complex options trading strategies. I'll go through these in the options section because options are not for the faint-hearted. They're very complex instruments, and options give you the option to do something in the future. And you can either buy that option or sell that option. And if you're selling options, that means you're receiving a fee from someone else for giving them the right to do something in the future. And so receiving fees, that's why they put it in Earn, because you can receive those premiums. However, when you trade options, you're at risk. You have to do something in the future if the option gets called. And so I'll explain that in the options section. But this right here, essentially, flexible savings, that's lending. Wealth management, I showed you that. Dual asset, liquidity mining here, this is different. And this is actually taking risk. And you may get back less than you put in. It's not just a simple credit risk or staking risk, right? This is, I'm trading and I could be with something that I don't want in the future. So I'll explain that in the options section of this video. But if you see these very high APRs, that's not an APR. It's not an interest rate or a yield. You're trying to actually earn premiums from option strategies. And if the option is called, you could end up with an asset that you don't want. So it's important to realize that. But I'll go through that in the more complex options guide later in this video. Now we'll move on to more complex trading, and I'll show you margin trading and then trading in the futures market as well. But all of this is managed within your unified trading account. So first, a quick explainer of why margin and futures are very different to spot trading. So when you think about spot trading, that's known as cash settled. You have an amount of money, you trade it for another asset. You sell, you buy it, that's it. With trading on margin, what you're doing is actually borrowing money to take a trade. And with margin, you actually just pay an interest rate to borrow that money. And the reason that you can do that is because you have some collateral, either dollar stable coins or crypto, in your unified trading account to pay for losses. It's a bit like taking out a mortgage where, you have this big loan and it's collateralized against your house. Well, it's the same here. So if you take a margin trade up here, you can see margin. So we've gone from spot here. In the spot trading screen, we go to margin. Margin lets us borrow money to trade with. And the reason we can do that is because we have collateral on the unified trading account to pay for any potential losses. That's it. And so really, you can trade with pretty much anything you want. But Bybit here have 5x margin, as you can see. But as we go down here, you can change that 10x, 9, 8, 2x, whatever you want, right? Obviously, 1x is no margin, so you trade in the spot market. But 2x is doubling the amount of money that you have in your unified trading account. So you have $1,000 there, you can trade with $2,000 upwards, right? And so it becomes a little bit complex, but we can go through it where when you're trading on margin and when you're trading in futures, you are not cash settling the trade when you open the trade. You simply have an amount of collateral in your unified trading account to pay for any potential losses. After that, you can just trade pretty much anything that you want up here. But of course, what you have to manage now is the value of your collateral and the amount of leverage that you're taking. So going back to this example, this is for futures, but it works with margin in the same way, right? You have a collateral that you put on the unified trading account to pay for any losses. Now, Bybit as a trading system, every other crypto exchange, they should not allow any bad losses. And so let's say you put $1,000 in your unified trading account to trade with. You can go and open up a trade with 2x margin, meaning you can open up a trade worth $2,000 with the market. Now you have $1,000 to pay for any potential losses. Basically, percentage movements in the price are doubled. So on your 2,000 trade now, if the price goes up 50%, that's like 100% on your original capital. So just 50% move is 100% or original. Now to the downside, if the thing moves down 50%, that wipes out 100% of your original capital. So with 2x margin, you're doubling the volatility. With 10x margin, you put $1,000 in, you open a $10,000 position. Now, a 10% move to the downside wipes out your original capital. So with margin, you're borrowing money and paying for potential losses. When you are borrowing money, the more you borrow against your original capital, that increases the volatility of percentage price moves in the actual market. So that means it's increasing risk a lot. Now there's ways to do this. You put $1,000 in, you open a $10,000 trade. Thing goes down 9%. So you're going to get a margin call from Bybit. They're going to email you or send you a message saying, look, man, you're going to get liquidated. You basically, we're going to sell out your collateral to pay off your trade because we don't want a bad debt. So what you can do there is either sell out and make the loss, or you can just put more money in, put another $1,000 in, right? and then you basically decrease the leverage because you're starting to pay off your position now, right? Even though you're still making a loss on the trade, but you need some collateral here first. That's the first thing, and there's many ways to do that, which I'll show you in a second. Then you trade on leverage. You can trade with more money than you have, right? Then you have a P&L and a liquidation. You have a profit and a loss based on the trade position and everything. So with 2x leverage, 2,000, 5x leverage, you can trade with 5,000, 10x leverage, you can trade with 10,000. And as you can see, the 10% loss here on each of those is wild. So a 10% loss on a 10x leverage is basically your position wiped out. So that's margin, where you can borrow money to trade in the spot market. And you can do that. Or you can go over to trade if you want to trade futures. This is a completely different product. Remember, this is real cash settling the asset. So when you're borrowing on margin, you're literally borrowing money to actually go out and cash settle the assets. With futures, futures is just trading a derivative of the underlying price of the asset. So this here is not buying and selling crypto. This is buying and selling the price of the underlying crypto. And it's a derivative contract. It's literally a contract between you and the market to buy or sell, and then exchange the balance when you get out of the trade again. In any case, with futures, you can also take leverage like this, 2x leverage and up, because again, you just need to pay for the potential losses. So you open the contract and you close the contract. If it's a profit, great news. If it's a loss, you have to exchange the balance of your loss. And so you only put money on the futures market to pay for potential losses. You don't have to put all the money into open and close positions. So that's it with leverage. That's how that works. But it's different between margin and futures, but it all comes within your unified trading account. Now we can go back to the unified trading account. I showed you this earlier, but we can go through more in depth on how margin works here. So unified trading right here, so under your assets, and up here is essentially the amount of leverage that you're taking. So think of your unified trading account as the balances that you have in cash and the equity that you have in your account. So the equity that you have in your account is the amount of money that your positions are worth. So you might have $1,000 of cash that you put in, US dollar tether. You made some trades and you made loads of money on those trades. And now your account equity is 10,000. Well, great news. You actually have more to play with. You have equity in your account to take other positions with, right? Because you have those profits that basically mark to market, right? The value of your trades and cash, the equity of your account, mark to market is a certain amount, and it's about 10,000. You now have equity in your account to pay for new trades. Because at any given time, if the price comes down and you lose, Bybit can trade out of assets, use your collateral to pay off any potential losses. So you have that up here, and then there's different ways to do this. The other thing is, within your unified trading account, there are certain assets that you can use as collateral. Mostly it's USDT and USDC, where you're putting a cash balance on here, basically. Treat this as cash, US dollar cash, and that's to pay for any potential trades. Now, a lot of people do that because a stable coin is a value of $1 always, or it should be. And so you know how much cash you have in your account to pay for potential losses. And so it's very easy to work out. You have $1,000 in, you know exactly what your trades are and everything like that. So you can see here, these are automatically used as collateral. However, you can also put crypto collateral in your unified trading account as well. And you can toggle these on and off as you want. So Bitcoin and ETH are used as collateral. If we scroll down, there's a bunch of other assets. What the unified trading account does is it takes the US dollar value of those assets every second or millisecond, or whatever it is, the mark to market value of those, in case you make a loss and they have to sell those assets out to pay for your losses. So you can use stablecoin collateral, which is obviously, very reliable because you just know the value there, but you can also use crypto collateral, which can be used to collateralize positions, but also increases the risk because your collateral is now going to move with its US dollar exchange rate. You can toggle these on and off as you wish, right? So do that. Now, also I explained the USDe in the Earn section right here. USDe is a stablecoin from Athena, way more risky than normal stablecoins like USDT and USDC because it uses a different strategy. you may or may not want to use it. Go back to the Earn section if you skip that to understand what USDe is. But USDe actually pays a yield as well. You can see 10%. So what some people can do is if they want that dollar collateral there, they can put that in their trading account and they actually get 10% yield from that stablecoin as of right now. That can change over time, but that actually, if you're using USDe as collateral, with that 10% yield, basically pays for most of the margin interest rates or funding fees that you may be paying in some of your positions. So it can actually cancel out some of the interest that you're paying, which is obviously slightly attractive for a lot of traders. But again, there's slightly more risks there, so you may not want to use it. In any case, these collateral assets can be used if you want or not to collateralize positions in the market, either through margin or through futures trading. Now, really important as well is that if you want to split the risk within your unified trading account, so let's say you trade in the spot market and you trade with a bit of margin or no margin at all, and you just want that here, but then you have the idea of just taking a bunch of really risky trades as well. You kind of don't want them contaminating each other, because they will do in the same crypto account, in the same unified trading account, right? So if you just have some Bitcoin in here that you just bought and you just want to keep it in there, maybe you're looking to sell out and so you want to put it in your unified trading account, that will automatically be used as collateral. If you've got a bunch of futures trades here with high margin that you're trading super risky, and they go south, they will use your collateral out, which is not good, right? So if you want to split that risk, what you have to do is create a sub account. I showed you that at the beginning of the video. So go into your settings. I think it's up here, settings, account, sub accounts. If you want to split and firewall risk of different trades, create sub accounts and then treat each of those sub accounts with their own unified trading account with the margin balances of these assets that you're putting on there. Before trading on margin or in the futures market, we also have to choose the way that we margin our positions. So back in the trading screen, I'm just in trade here, spot trading, Bitcoin USDT. And I've gone from spot here and I've gone margin right here. Now we have to choose the way that we collateralize and margin our trades. So as we come down here to unified trading, you can see I've got some assets in here, USDT, I've got a bit of Bitcoin. The borrow size is 0 because I'm not borrowing anything right now. I have no positions open. So it's really important to choose the way that you want to margin your positions. So you can click this just above my head where it says cross margin. I'm going to click that and it brings up the different margin modes that we can use. And it's really important to understand the differences here. So I'll explain these. Both isolated margin and cross margin can support trading in the futures markets and in margin mode, right, in the spot market. These modes here, what is one way and hedge? So one way is when, let's say you're trading Bitcoin USD. So you open a long position, you buy Bitcoin USD. That means that you are long Bitcoin and you're hoping for the price to go up. One way means you can only open that order and that's it. So you open the long in Bitcoin USD and you're long. Let's say you put $1,000 trade in. One way means if you have that $1,000 trade open one way, if you now want to short the asset or sell the asset, because you've got this trade open, you're making money, but you think short term the price may go down. So you want to take a short position and trade short term to take a short, right, and then buy back lower. You can't take a separate position. So you can't have a buy and a sell position open at the same time. What you have to do with one way is, let's say you went long $1,000 and you want to take a short position now of $500. You actually have to take that short position and it cancels out some of your trade. So maybe you made a profit and now your trade is worth $2,000. You want to take a $500 short, it will take out of the long position. So now you only have a $1,500 long. And then if you want to take a short again, you have to keep winding that position down until it's closed. And then only when it's closed can you actually take a new short position. Hedge mode means you can open both a long and a short simultaneously at the same time with the same asset. So you're long the asset in one trade, you can be short the asset in another trade as well. For the most part, hedge mode is just a bit easier, so you may want to use that one. Now, the difference between cross and isolated margin is essentially how the collateral is managed. With isolated, you can see here, trade perpetuals with corresponding settlement assets. If you're trading Bitcoin USDT that product, right? So in the spot market, you're trading Bitcoin USDT trading pair, or in the futures market, you're trading Bitcoin USDT pair. You need that collateral asset to collateralize that position. So you need USDT in your account to collateralize. If you're trading Bitcoin USDC or Bitcoin USDe, those are different trading pairs, and that's different collateral. Now, they're all meant to be stable coins, but they're not the same thing. And so if you want to open a Bitcoin USDC position, you need USDC in your account to collateralize that position. You can't use multiple assets in your trading account, in your unified trading account, to collateralize your positions. So you can't have some USDC, some USDT, some Bitcoin, some ETH, and the US dollar value of it is collateralizing. You can't do that. Isolated margin, you're trading Bitcoin USDT, you need USDC in your account to margin that position. That is for regular users who just don't want the complexity of having risk assets margining their positions. So for beginners, you may want to start out with here and just test the waters a bit. Cross margin, the difference here is that, as you can see, it enables trading with USD value of multi-asset collateral. What this means is go and put USDT in your account, plus some USDC, plus some USDe, plus some Bitcoin, plus some ETH, plus some Solana. The US dollar value of that, mark to market every second, is going to be used as USD value to margin any of your trades. That's more risky because now you have risk asset collateral margining your trades, which means your collateral itself moves in value versus USD. And so this is more risky. It's known as cross margin, cross asset collateral margining your positions. You need to know what you're doing a little bit more. You need to understand how these assets may move, because if you're opening a trade long Bitcoin and you have Bitcoin as the collateral, that increases risk. Because let's say you're long, you buy Bitcoin with Bitcoin collateral. Let's say the price falls. Not only is your position losing money, but your collateral is losing value. So the losses are kind of exponential. And so you may think I've got 50% as an amount to trade, but actually no, because the collateral is losing value. So it can unravel very quickly. But the reason people use cross margin as well is because people don't want to use dollars to collateralize all their positions, right? If you're in the dollar, that doesn't move anywhere. You want your Bitcoin. You don't want to sell your Bitcoin. So if you want to trade the Bitcoin, you want to use it as collateral. However, it does increase risk. So choose the one that you want. I'll be using cross margin for this example. Portfolio margin goes an extra step and uses absolutely everything, including your spot P&L, to actually figure out your collateral that you have. This is more for your professional derivatives traders, people that are hedging, probably family offices and things that have multiple accounts open. I would say that individuals really don't need to use this one. Cross margin is absolutely fine, or isolated margin. I'll choose cross margin for this example. Choose what you want. If you're a real beginner, maybe just do USDT, get familiar with that, and then you can start margining your risk assets as well. But the risk here is that something goes wrong and you're out of your risk asset as well. So definitely make a choice depending on how much risk you want to take. So choose your margin mode first. Now let's open a long position whilst using the margin that we have on account. So the margin is 2x and I'm using cross margin here. And then down at the bottom, you should see my unified trading account balances. I've got $200 of USDT. I've got a bit of Bitcoin in the unified trading account as well. Now what I'm going to do is show you the unified trading account. And this is it right here. So this is the balances. Again, it's the same that we saw in the trading screen. So $200, and we've got a small amount of Bitcoin in here. And we haven't got anything else. We've got some Ethereum, and that's about it, right? $12 of Ethereum. And that's important because you'll see why in a second when we open and close the positions. But from here, we have the initial margin and the maintenance margin that you need to pay. So when you use margin, as soon as you open that position, you do have to set aside what Bybit call maintenance margin and initial margin. Initial is when you open the position, there's a small amount here. It's like an insurance. If anything goes wrong with a trade or anything, I think it just has that there. And then maintenance margin is the amount that you need as a minimum on balance to maintain the margin or the loan basically that you're getting given. So total equity is exactly the same as my margin balance. The reason being is I don't have any open positions in this account. So equity is the value of what I have here. In fact, you could say that these positions are open because I've got a risk asset here in Bitcoin. And I suppose if that goes up, then my margin balance available and total equity will grow as well. But for right now, I don't have an open position as such with margin. So from here, we're going to go back into the trading screen, 2x margin, and we're going to open a long position. Now with 2x margin, that means that I actually have available to trade with double what I have on account. So that's $422 worth. The reason being, I've got $200 here, and I've also got a bit of BTC that is available to be used as collateral, right? So the value of that actually adds to the amount that I can trade with. So let's go and open a trade right here. I'll choose a market order just to get the trade done for you. And we're gonna trade $100. Now, if you press buy or long, it comes up with the box right here and it says, this is the order type, this is what you're going to do. And you can see that the account to borrow is 0. The reason being is that in spot, you aren't going to borrow anything unless you're actually trading with more than you have. So if I go ahead and do this, this is just me spending my cash to go ahead and buy Bitcoin. Remember, we're in the spot market here. And in the spot market, this is real crypto trading. And so if we're buying, we have to cash settle this asset. All right. And so it's not like a contract or anything else where we're just exchanging the balance. Someone is selling it to us and we have to cash settle immediately with them in USDT, giving them USDT. So for us right here, we're not borrowing anything because our trade isn't big enough. So what we're going to do is go back and we're going to make the trade bigger. So let's trade with 300 and right away you can see that your amount to borrow goes up. I've got $200 here and obviously my trade position being $300, I borrow $100. By long, you can see now I have an amount that I can borrow. So I'm going to buy or long BTC, press buy, and then we have it right here. Now my open orders, I don't have any open orders because that order actually executed. What I have is what's called a borrowings. You can see that here. So what I've actually got now after pressing that buy long is I have actually bought that Bitcoin. That is mine now. And it's not waiting to be paid off. That Bitcoin is mine. But what I do also have now is a USDT loan with Bybit. Okay, so that is the liability that we have now. So we've actually bought that BTC. Go back to the unified trading account. It should have refreshed already. Yeah, you can see refresh now. So what we have is an actual position in Bitcoin, way more than we had before, and also a negative balance of USDT. That is our liability now that we have to worry about. So you can see the account equity is going to change now because we have way more BTC. So that's going to change in value. Now, if the price of Bitcoin goes up, our equity is going to rise in relation to the value of our loan, which is going to be fixed plus the interest. So you can see that here, and we have some tiny amount of initial margin, maintenance margin that we have, and the initial margin right here. And so we now have this loan. So what are we going to do? Well, we need to pay off this loan. So there's two ways to do this. The first one is to literally pay it off with USDT. So I'm going to go back to the trading screen. What we're going to do is go down to my unified trading account. Over here, it says transfer. So I'm going to click that. It's just below my head right now. And it's going to say, what do you want to do? So I'm going to transfer some USDT from my funding account into my unified trading account. Let's do $25. I'll press confirm. That should confirm for us. And what you can see now is that my borrowings have decreased. I've literally paid off the loan. We've got a USDT loan and I've paid it off by just getting USDT into the account and paying it off. So that's one way to pay it off. The other way to pay it off is to tell Bybit that you want to repay this loan. And what they'll do is they'll go to your unified trading account and they will simply sell the amount of Bitcoin necessary to pay off the loan. Because you've got the loan, right? And you now have the assets that you should be able to pay the loan back with. Now, there might be a small amount that you can't pay back if you've taken assets out of the unified trading account. But if I press repay, and then it says, how do you want to repay this loan? So I've got $74 that I need to repay. Now I had that cash in there as well, but this loan. So what are we going to do here? Well, that $200 that you had to pay for this plus the borrowing, that $200 is still in your account. It's in Bitcoin because the Bitcoin price hasn't moved, right? Basically. So we still got that $200 that we put in. So that's a lot of margin that we have. That's a lot of actual cash that we can use to pay off this loan, right? If the Bitcoin price falls, that's when your leverage starts to increase, right? That's when essentially the Bitcoin value is falling and Bybit don't really have a lot of assets to sell in order to pay back your loan. That's where you get margin called and liquidated. We've got loads of headroom right now. So what we're going to do is basically tell Bybit, look, I want to repay this loan, sell the amount of Bitcoin necessary to repay it. And if you have other assets in there that also can act as collateral, like ETH, you can use that one as well. But I'll just use BTC. So I'm going to press repay. I'm going to repay this loan plus the interest that has accrued over whatever time period. Press confirm, done. Now what I'm doing is I have no borrowings, right? I'm not borrowing any money anymore because they've sold the BTC in order to pay off the loan. However, when we go back into the unified trading account, you should be able to see that I now don't have a loan, but I also keep the Bitcoin. And that's because we did buy that Bitcoin. We had to buy it all. And the thing that we actually had a liability in then was the USDT where we took the loan with. So this can be used, right, a couple of different ways. You can use margin to literally trade with more than you have. If you're bullish and you think, I just want to buy long, I want to buy long with more than I have in the account. And, I want to essentially sell out in the future at a higher price, having gained equity in the account, having gained in Bitcoin. If you make money on the Bitcoin trade, that makes equity in your account. You can then sell that in the market to pay off the loan. So that's like speculating, which you can do. The other thing is you can just buy on margin if you know that you have money coming in, but it's going to be a bit late. So you might see that the price is pretty attractive. You want to buy right now, but your cash isn't going to be available for another week. You can just fund that for a week. In your Bybit account, when the money comes in, you can repay the loan, and then you don't have a loan for the Bitcoin. You actually just paid off the loan to get the Bitcoin. So that's on the long side, where you can, either long the asset and buy it, speculating, or if you think that the money's coming in at some point in the future. That loan always has to be paid off at some point. We can also do this on the sell side, which is where we sell Bitcoin if we have it, or you can actually sell more Bitcoin than you have. And this is the same as taking a short position in the coin. So you can open a short position with 2x leverage or 2x margin that we're using. My Bitcoin now, because I have Bitcoin and I don't have dollars, I've got 0.002 BTC, and that is worth roughly $245. But with 2x margin, I can go up and actually take a sell position with up to about $500 worth, right? And so what are we doing here? We're actually selling more Bitcoin than we have. And that is a short position in the asset. So when you trade, you always buy low and sell high to make money. Well, you don't have to buy low first and sell high later. You can sell high first and buy back low later. This is if you think the price is going to fall and you simply want to take advantage of borrowing Bitcoin because we're in the spot market. So if we sell Bitcoin, we have to cash settle that asset and give it to somebody else. That means we have to go out into the market and borrow it. So there will be lenders on Bybit who are lending Bitcoin, and we're going to borrow that Bitcoin from them and pay them an interest rate, and we're going to sell it to someone else in the market. And then for us, we hope to buy back lower and actually complete the sale and the buy, and then make money on a move down in price. Now, the risk here is that when you take a short position in an asset, you are selling it, right? So the money that you can make on the downside is limited by the thing falling to zero, which it may do. And that's when you close out the short, so you can make that money. But the other side of that is you're short, and the potential upside of the asset is potentially unlimited, which means you could seriously lose because you're shorting an asset, and at some point you do have to buy it back to close out the loan and the position. And so assets have theoretically an infinite price that they can move to. Now, of course, if you're trading over a week or a month or something, then there may be a real limit to the amount it can move in that time. But just from a technical perspective, your upside here is limited and your downside here is potentially unlimited when you take a short position. So when you do take a short position, how do you actually close out the trade? Well, you have to buy it back. And so you buy it back by the other side of the trade and closing out the loan that you made. So let's go on a short position. And I'm going to short $320 worth here, which is more Bitcoin than we own. So sell short BTC, you can see it here. And the amount to borrow is in Bitcoin. And you can see the daily interest rate for Bitcoin. So sell short, that's it there. Now what we have is a borrowing of Bitcoin itself. So now that's our liability. Our liability is Bitcoin itself. If we go back into the unified trading account page right here, you can now see that I have a debt and a liability in Bitcoin, and I have loads of cash. This is the same as taking a short position in the asset, selling it first. To close out the position, we have to buy back. So we can go ahead and buy back here. So again, if you have Bitcoin in your funding account or somewhere else, you can settle that very easily by putting the Bitcoin in and then repaying that loan. Or if you want to get out of the asset, just press repay. So let's go and press repay. This is it right here. And I'm going to use my USDT to repay this loan. So repay, that basically gets me out of the entire position. And it should, after costs and everything like that, should essentially net zero any borrowings that I have. Now let's look at trading derivatives, and we'll start with futures trading. So futures trading is not trading crypto, essentially. The prices of futures are based on the underlying crypto trading pairs. And that's why this is known as a derivatives market, because what we're trading here is a contract. We're just opening and closing positions based on the price of the underlying. So this contract derives its price from the underlying crypto pairs. We're looking at Bitcoin USDT here, but we're not buying and selling crypto. We are just opening and closing positions, and we're taking a profit or a loss based on the prices that we open and close positions. And because of that, we don't need to cash settle the assets. We don't need to take any loans, to take any leverage. All we need is some collateral on the system to pay for any potential losses. So we'll very quickly go over crypto futures here. So you need some sort of collateral in your trading account in order to pay for losses. That can be dollars or stable coins, or it can be coins as well. And there's a difference here because, like I said previously in the margin section, when you use dollars, you have a fixed amount of cash there to settle positions. So you know you have $1,000. That's not going to change. You always have $1,000 to pay for positions. If you use crypto assets to margin, then this is more risky and more volatile because these coins are essentially turned into a dollar value of them, mark to market every second, and that can change. So you might put $1,000 of Bitcoin on, but if the Bitcoin price falls 50%, you've only got $500 worth of Bitcoin now. And that is the dollar value is used as the amount of collateral that you have to pay for positions. So this one has some benefits, but some cons. It's way more volatile and risky, and the price of the asset can move. It can move against you, but it also can move for you. So if you keep your exposure to a risk asset and it goes up in value, you're gaining collateral to put into positions, which is a good thing. So more volatile, more risky, but potentially good or bad. And this one is just solid. $1,000 is $1,000 and that's it. But you actually don't gain from any potential positive volatility either. From there, you take your trade and you choose your leverage, whatever that may be. We saw that in the margin section. So you can take basically whatever margin that you want, but you're going to have to pay for the position. The more margin you take, the more volatile it will be. On Bybit and the other major crypto exchanges, there's two types of contract that we can trade. One is known as coin margined and one is known as US dollar margined. So it's the exact same type of thing, but it's just relating to what exactly you're using to margin your positions. And so let's go through the pros and cons of both of those. On Bybit, if you go to futures here, and this right here is USDT, which is the USDT pairs. This is what most people trade. And this is stable coin margined or US dollar margined. We also have on Bybit coin margined, which on Bybit is known as inverse. Inverse is coin margined. And so what's the difference here? And I want to be super clear about this. It's really important. USD margined, you put dollars on the system to pay for any potential losses. You put $1,000 in, you've always got $1,000 there to pay for losses, and you make wins or losses against that. So if you put $1,000 in, you open a trade of $1,000 in Bitcoin. Bitcoin goes up 20%, you make 20% of the dollars that you put in. So you make $200. If it goes down 20%, then you make a loss of $200 on the collateral that you've put in, which is $1,000. Coin margined uses the coins to go ahead and margin your trades. Extra volatility. If you put $1,000 of Bitcoin on and it goes down 20%, you opened a position, your position is now in a loss, and also your collateral is now losing value. And so your liquidation price essentially gets pretty quickly into the liquidation zone because your collateral is losing value against your position and your position is losing value. So actually the volatility increases and you get exponential losses down to the point where you get liquidated. It also works on the flip side as well. You put $1,000 of Bitcoin on, you take a long position, Bitcoin goes up 20%. You've now got the 20% gain in your trading position and your collateral is moving up as well. So you've got exponential gains to the upside in that case. Extra volatility, and it can work out for the good or for the bad. Obviously, that's down to the trade. So US dollar margined or coin margined. US dollar margined, quote and settled in USDT. You make your wins or losses in USDT. The pros of this are great liquidity and very easy to understand because you know how much collateral that you have to pay for losses. And you know if you make 20%, that's 20% of the $1,000 you had in. For coin margined, the price is quoted and settled in crypto. So this generates maximal profits in bull markets. Your leverage, your margin, and your position moving up exponentially. In bear markets, you're going to get wrecked because both are moving down. All right, so extra volatility and potential wins or losses there. So it's up to the individual. A lot of beginners will start with USD margin to just get the hang of it. But if you're looking to take a riskier trade or you're in a bull market and you don't want to margin your position with dollars. Okay, people that have been in crypto a long time, they've got Bitcoin, they've got Ethereum, they've got Solana, whatever it is, and you want to trade that. You don't want to sell your Bitcoin to then go and trade against dollars. That's ridiculous. You want to trade against your Bitcoin. So if you have Bitcoin, you want to trade against it. If you want to take a long position, you use the Bitcoin to margin and you can make gains in a bull market. Conversely, if you put Bitcoin on the futures market and you want to take a short against it, you can hedge your position. You have Bitcoin as collateral. You don't want to sell Bitcoin. That is money. What you want to do is you think, well, look, we're going to be a bear market. The price is going to go lower. I can put the Bitcoin on to margin a short position and basically hedge my exposure to the Bitcoin I have. Because then the Bitcoin's losing value, but you've got a short position which is gaining value. So that hedges your trade. So there's many ways to play it, right? But people that are speculating, just speculate with dollars and you just make some money. But on the coin side, that's for people that own assets and they want to hedge their positions. They either want to trade with more and try and leverage up their assets, or they want to hedge against them to the downside. So this is a more professional way of doing it if you actually have coins. If you're looking to just take some trades and try and make some money at the market, people like that, because they know, okay, I've got $1,000. I know that if it moves down 50%, I'm using 2x leverage. That will be liquidated. I can put a stop loss in at, something like, 40%. So that's for more speculating on the price. This is for people that own the assets and they want to take a position against them. Along with the two separate ways that we can margin our positions, either dollar or coin, there's actually two completely separate types of contract that we can trade, which are known as futures. One is perpetual and one is delivery date. Perpetual meaning there is no expiry date to this contract. It goes on forever. You open and close positions to get in and out. There's also delivery date futures, which have a specific delivery date in the future, and therefore that contract expires at a specific date in the future. There's some nuances between them, so I'll go over this. Perpetual futures have no expiry date. They're actually very, very common to crypto, and a lot of people trade these. So open your position, close it when you want. There is also delivery futures, where at some expiry date in the future, you are expected to take delivery of the underlying commodity, right? So in actual futures markets, commodity futures markets, if you're long the asset in futures and let it expire, it is expected that you will then expect delivery of that underlying commodity and get delivered the oil or get delivered the corn or something like that. In crypto, that doesn't happen if you trade delivery futures. What happens is the crypto exchange will work out your profit and loss and then settle the transactions either in the dollar or the coin margin that you've used. And so you won't be expected to exchange underlying spot assets. They'll just take the profit and loss in your position and put that into a unified trading account. However, you still have these delivery dates. So go to your trading pairs in futures. Up here, we'll go perpetual versus spot. So perpetual is just designed as a futures contract that tracks the underlying spot price 1-for-1. And so you can see there's one contract per pair here, Bitcoin, ETH, SOL, there's just one for each. And this contract is designed specifically to perfectly match the underlying spot trading pair 1-for-1. Because it's perpetual, there's no expiry, this must match 1-for-1 the price of the underlying spot pair. Otherwise, if it doesn't, then it's not matching the underlying spot pair and therefore it's a completely untradeable asset. The problem this makes is that with perpetuals, the exchange, every exchange has to make sure that the future and the spot have the same price. And the way that they do that is what's known as through a funding fee. This funding fee is a fee to make sure that the price remains in line with the underlying spot price. I'll go through that more in depth in a second because it's important to understand it if you're trading it. With delivery futures, you don't have any funding fee. And the reason you don't have a funding fee is because the future with delivery isn't actually expected to track the underlying price. It is open to supply and demand where the price goes. And so, yes, it is anchored to the underlying spot price because eventually the future will expire, and it is expected to expire with delivery of the underlying, even though you do get delivery of the underlying. But what the exchange does is just work out your profit and loss and put that into your account. But delivery of the underlying is expected, which means that this futures price can be wildly different than the actual spot price over time. But as the expiry gets closer, it's going to trend right into that what the spot price actually is. So you can see for Bitcoin, we have a bunch of different contracts here, the different expiries. So we have Jan, March, June, September. And what I'm seeing here, the market is telling me that it expects the price of Bitcoin to rise this year because as of making this video, it's close to 31st of Jan, 105, 107, 110, 113. It's expecting the price to rise over time. That's known as a futures curve. And so you can plot that as a curve over time. But the market's telling me that it expects the price to rise over time. Now, the way you trade this future is, let's say the June expiry. The market is currently pricing the June expiry to be 110. So do you think that's too cheap or too expensive? Because by June, what do you think the price will be? So if you think that the market is pricing too cheap, then you buy 110s. And you think the price may move up to 120, 115 by the expiry, and you can make that difference. If you think they're too expensive, you think it's going to finish at 105, then you sell those 110s because you think you're going to sell and buy back at 105 lower. Now, that also creates a little bit more volatility because depending on what the spot price does and what people think about the future, they can actually wildly price it differently than the underlying spot, right? And so you can get some slight more volatility here, or at least more opportunities of mispricing what you think will happen in the future versus what the market is doing. And so if you're in a trend, you might want to just go long the asset. And even if you buy 110s, as long as at some point those 110s reprice to 112, you would have made a profit. You can get out before the contract expires and lock in your profit there. And so this is a little bit more volatile in terms of what the market thinks. Now, if you are trading expiry futures, you also have to figure out what this futures curve is. And if you think it's accurately pricing what you think will happen, or if you think there's a opportunity here. So that is known as two things basically, which let it get a little bit complex, but there's two ways that a future can be priced versus the underlying spot asset. Most of the time, it would be expected that the future is in something known as contango, which is where the future is priced higher than the spot price or the expected spot price. So that's what we're looking at here for the 110s, right? So let's just stick on the 110s. In June, it's pricing 110. Now the current spot price of Bitcoin is about 105. So if we go back, this would be here, this would be now in January, and this is the expiry in June up here. So we're in contango because the price is pricing in a higher futures price right now. But what happens is, as the future becomes the present, the futures price will more accurately reflect the underlying spot price over time, because it must do, because there's less time for the price to move, right? The price can only move in 1 day versus 6 months. So 1 day, not a lot of volatility. 6 months could be a lot of volatility. So this contango will eventually come into par or into the spot price as the contract expires. That doesn't mean that you're losing money, right? It just means that the delta, the spread between the spot and the future will converge to no delta, no spread at all, no difference at all, right? But that's good if the price is rising to 110, that's awesome. And if the spot price itself moves higher, let's say you get into these 110s and the spot price itself moves to 120, actually before the contract expiry, this thing is going to price way higher. And so you can get some kind of extra volatility on that move. Works to the downside as well, for sure. The other way that can happen sometimes is that the futures contract is actually priced below the expected spot price. And so let's say Bitcoin's trading at 105 now. Maybe the Junes are trading at 100 or 95. That could happen. And that's just the market telling you, we think the price is going to fall over these 6 months. And again, that delta may be very big, But let's say the price doesn't move, it just goes to 100. That delta is going to move and change up into the spot price over time. But in any case, whatever happens, the difference, the delta between what the future is and what the spot eventually is, will eventually go to zero. Because as the contract expires, it has to be exactly the same as the spot price. So futures contracts are a little bit more complex here. Most people in crypto do trade perpetuals. It's a bit easier to understand, and all they really want to do is just get price exposure to the underlying asset without having to factor in backwardation, contango, and what the market is pricing in the future as well, which can increase volatility for sure. I also need to explain what funding is, and this is only for perpetual futures. So again, looking at this grid, perpetuals, the period has no expiration. You open and close the position whenever you want. For delivery futures, like we saw, where you have the delivery here, so we'll trade this asset pair, we go to futures, we have the delivery dates. They do not have any funding. They expire and do not have any funding rates. What is a funding rate? So because the perpetual futures contract has no expiry, it means that the price must track the underlying cryptocurrency trading pair, Bitcoin USDT. This perpetuals contract must track the underlying asset. Otherwise, the thing becomes untradeable. If the price of this synthetic contract is miles away from the underlying spot pair, then no one will trade it. Because what are you trading at that point? You're supposed to be trading this spot pair, BTC USDT. You have to trade the price of that. If it's miles away, then you don't, how can that, you can't trade it. It's impossible, right? Because what's the price? Someone can push it up or down, or what price is it? Is that expensive or cheap or whatever? You can't have that. So there's a problem here, is that there's no expiry, and the exchange has to try to keep the contract in line with the underlying spot price. But the exchange doesn't have control over the price of this contract. This contract, the price here, is dependent on supply and demand from us. And so what can happen is that traders can come in and push the price away from the price of the underlying spot pair. And so what the exchange needs to do is incentivize people to try and bring the price back in line with the underlying spot pair. So they do this via funding. Funding is up here. And what funding is basically a fee to make sure that the price of this contract tries to stay in line with the underlying spot pair. And it's a fee that is paid by either side that is out of sync with the underlying spot pair. So let's say that many buyers come into this contract and start going along. Well, they're going to be pushing up the price. And let's say that the price moves away from the underlying spot. Well, that's an issue. So the exchange goes out and says, you guys, because the price is above the spot price, you guys are going to have to pay funding to the other side of the order book, to sellers. You're going to have to pay a fee to do that. And that disincentivizes people to go long, and it incentivizes people to go short. Because if they're going short, they're literally getting paid. And so this brings the price back down. On the other side, if sellers come in and force the price way down low, then the exchange says, wait a minute, there's too many sellers. We're going to make you pay this fee, this funding fee, to longs to incentivize them to come in and buy, and disincentivize you to sell and push the price back up to what it should be. So the funding rate is just trying to keep the price in line. It is mostly positive in crypto. So there are mostly more buyers pushing prices up in futures than there are sellers for the most part, because the asset class is growing, and so prices are generally rising. So on balance, it's probably better to go long for the most part, especially in bull markets. And so you will see most of the time that the funding rate is mostly positive, which means the longs are paying shorts. And you can work this out. So this is exchanged every 8 hours on Bybit. So you can work out this funding rate, make it a daily figure, times it by 365. For the most part, funding on the big pairs is going to be anything around 10 to 15% a year, something like that. So it's like paying interest on a loan. If you're going long, you are having to pay 10 to 15% a year in funding fees to shorts if the funding is positive. However, it's not always positive. It's sometimes negative as well when shorts pile up. And so if you're long in that situation, you actually receive that funding. And so that's exchanged every 8 hours. If you've got a position open for a week, it's basically irrelevant. But the longer you have it open, you're going to be paying a lot in funding fees, especially if you're using larger trades, right? So just something to be aware of. If you're winning in your trade, then it doesn't matter because you're going to be making money anyway. But for sure, with some altcoins, if you're taking a lot of leverage on smaller altcoins, you're going to have to pay a funding fee that's pretty high because some altcoins get very, very detached. The funding fees can go crazy, 50, 80, 100% for short periods of time, and then it comes back in line. But if you've got an open position and you're long and the funding fees are positive, you have to pay it. So something to keep in mind. But for the larger pairs, for the most part, the funding fees are quite mild, so it doesn't matter too much. But you can go into every single pair, just see what the funding is over time, see what the history is. I think it's this one here as well. You can see funding history. It's up here, derivatives info, derivatives trading data. You can see the past funding rates, the actual funding rate, and you can see the history of it over time to get an idea of what it might be when you open a position. Before getting into some live trades, there's just one more thing that we have to be aware of, which is even more complexity. So I showed you that there's two different types of contracts, right? US dollar margined and then coin margined or inverse contracts. US dollar margined is using dollars to margin, coin margined using coins to margin, right? Volatile assets, more volatility, volatile assets, volatile collateral. This doesn't, it's just USD. However, in your Bybit account, there are different margin modes where you can use different assets to collateralize. So we'll go down to margin mode here and then cross margin that I'm on. Now, I explained this in the margin section, so if you did skip that, go back and watch it. But if we use cross margin, that allows us to use dollars and crypto coins to margin positions. So even if in the futures trading platform, we are trading dollar margined futures, it is still possible to margin that with Bitcoin and ETH and others, which are volatile. So even if you think you're using this and you know full well that you've got $1,000 worth of collateral in there to pay for positions, if you're using cross margin mode where you can use Bitcoin, that's going to be volatile. It's the dollar value of that is going to margin your positions, and that can change if you're using cross asset collateral. So just be really sure that if you are trading in USD margined, that are you using dollars to margin or have you got some Bitcoin in there as well? That's going to change the volatility profile of your trade. With coin margined here, you do actually have to use the underlying coin. So we go up, we press trade, futures, we go to inverse or coin margined, we press BTC USD, and then that's a completely different contract. And you are exchanging the difference in the underlying. You can see now that the margin balance is switched to BTC, right? So you have to have the BTC in there, and that's easy. It's coin margined, we're using the coin. However, if you're using USD margin contracts, you can still margin that with underlying risk asset collateral in cross margin. So to be super sure exactly what you're doing and that you're happy with the margin, the volatility profile of it. Let's go and open a live trade in the US dollar margin futures then. So the first thing we have to choose is what type of margin mode that we're in. I'll choose cross margin, and what type of collateral that we have to fund our positions. Either dollars, or you can put some risk asset collateral in there, and the dollar value of that funds your positions as well. From here, you just choose how much leverage that you want to take. I'm going to use 2x leverage. Now, the difference here between futures and margin is that when you trade on margin in the spot market, you only borrow money if you're opening a trade that is bigger than the amount of cash that you have. So we saw that in the margin section where, let's say I had $200 and I opened a $100 trade. Well, it would just cash settle that because I don't need to borrow any money. It's only when I want to trade with $300 that it borrows $100 for me. That's not the case in the futures market. In the futures market, your leverage will always be more than you put down. With futures, you choose the leverage, and that dictates the cost of your order and how much you have to tie up in the order. So with 2x leverage, let's say I want to open a $1,000 trade in the futures market. It doesn't matter how, as long as I can pay for the potential loss, it doesn't matter. I have a $1,000 trade, and with 2x leverage, that means that my cost will be $500, right? So 2x leverage means how much down do you have versus the size of your position. So 2x would be 500 down, $1,000. If I went 10x for that $1,000 trade, then I only put down $100 for that $1,000 trade. So your leverage is simply how much of your collateral versus the position size. And it is always leveraged. You only put down the minimum amount. So we will go and open a market order here, and we're going to go long, but up here it says order by. So let's have a look at these. Order by quantity is if you know how much Bitcoin that you want to trade or the other asset. And you can let's put this in, so we'll press confirm. And we want to trade, let's say, this much. Okay, 0.01 Bitcoin. Now, you can see the difference here, the value and the cost. Like I said, with margin and leverage in the futures market, you're always only putting down the amount that you need, and then you're choosing the leverage, which will be the leverage on top of what you put down, and that will be the order value. So with 2x leverage, we want to trade 0.001 Bitcoin. At the current price, the value of the trade in the market would be 105. And the cost would be half of that, roughly $50, $52, right? That works out perfectly. Now, you can do this when you're entering the order as well, because you may not specifically know how much of the asset that you want to buy. So order by cost is going to we can tell the system, well, how much do I actually want to tie up in the order itself? How much is it going to cost me in my funds to fund the position? So if I want a $50 cost, then that's going to work out, we'll do 0.01 again, 0.02. Okay, 0.02. You can see that for 140 cost, that's going to more or less double into a 280 position. It works out a little bit different here because you can only trade specific increments of Bitcoin. So it's not perfect here, right? You can only open, a fraction of a unit, right? So there we go, like a 75, which works out roughly 150. But obviously you don't have to put as much down. Then we go to value. This is the trade value in the market that you're trading. So now you have to work out, if I open a $1,000 position or anything, how much is it going to cost me? So if I open a $250 position with the market, I'm using 2x leverage. So my cost is going to be half of that, which is 125. And that shows me here the cost is 125. So that's how that works out. Now, that is how you open positions. I really usually go by order by value most of the time. Because let's say 200, 2x leverage. So yeah, we can open a position like this. And I know that if it's 104, then I'm going to probably have to type around $50. So that would be it. Now, when you put this in, so you can open long, you might want to calculate your liquidation price as well. The liquidation price is, so you open a position here at 105,000 and I've got $50 to pay for losses. Well, at what price does that $50, if we move straight down, at what price does that $50 run out and I get liquidated at? Which means Bybit is going to sell out my position to make sure that I don't have a bad debt. Well, you can work it out pretty easily on 2x leverage. It's going to be half of what you get into, right? So if you open at 100, then you're going to get stopped out at 50. So that's easy for 2x leverage. It's half. And then, of course, for 10x leverage, then that's a 10% move to the downside and you get liquidated if you don't add collateral in to pay for the position. So we're going to open a position here like this. So I'm trading a $100 position. I'm going to have to put down $50 into the trade. From here, open long. So you're going long. So you hope the price is going to rise and then you can sell out later for a profit. So we'll do that first. You can input a stop loss when you open the trade if you want, or you can add it later. So we'll do it later. So open long. Now I've got an amount, I've got $200 in here to pay. So you can see the initial margin, the maintenance margin here, the order cost and value, everything here. So press confirm, that will open the order for me. Down here, we don't have any borrowings. That's not what we're doing now. We are just funding the futures position and funding any potential losses. So I now have a position. Bitcoin USD, it's cross margin with 2x leverage. Here's the amount of my trade. That is with the market. So 0.001 BTC. That's the value. The entry price, the mark price. The mark price is the official mark price of the actual contract itself, which may be slightly different from the traded price right here. The reason why that's important is because the contracts that we're trading may default to the mark price and not the actual daily traded price of the asset. Now, they're going to be very, very close. But sometimes what happens in futures is that you can have an error in the system. And the daily price, this price right here, can fluctuate wildly in a second and you get a big wick down and everyone gets liquidated. And the reason they have the mark price in there is to prevent that happening where you get an error or someone tries to come in and actually kind of disrupt the order book and try and liquidate everyone. And it's kind of like, well, that's kind of, it's kind of against the rules to do that, right? And so you don't want your contract being open to the market price. You want the mark price to come in and move a little bit more slowly so that you can agree that if you get stopped out or if you trade at a certain level, you will agree to trading the mark price and not the actual market price right here. So we have the initial margin and maintenance margin that we can see. We have an unrealized profit and loss. That is because our position is open and we haven't taken anything out of the trade. So we have an unrealized profit now. And then if it was an unrealized loss, that would go red. We haven't taken anything out of the trade yet. And this is realized P&L. Let's say you have a $10,000 order, thing goes up 50%. You want to take out some profits. Well, you can close the order, right? So you have a $10,000 order, you can close 20, 30% of that, and you take the position out and you are realizing the order then, you're realizing the trade and you've got a realized P&L. Now, if you want to add the take profit and stop loss in here, you can do that. So add in stop loss here. Target price can be anything we want. So let's put 60,000. The reason being that I'm in at 105 and my liquidation price, if the thing falls, is around 50% below that because I'm using 2x leverage. So that would be, for ease of use, let's just say we got in at 100 and it'd be 50,000 liquidation. You don't want to wait for that liquidation, right? You just want to put your stop loss in either somewhere much higher because you've done some technical analysis, or you at least want to put it in above that liquidation price, because if you're down there, you are going to be, and you get liquidated, you pay liquidation fees and some penalties as well, which again, if you're trading, not the end of the world, but you'd rather not have it. So you can put that stop loss in. So let's put the 60,000. I'll press confirm here. And what that is an open order. The reason being is that we have this position and that's a trade. But now we've just opened a stop loss order, which is a trigger order. And that trigger is open. The reason why it's open, you can see TPSL here, it's a stop loss. That is a trigger order that is going to sell out for a loss if the trigger is met. And so it's open now and it's actually linked to our futures position. So if I cancel out our futures position, on the right-hand side, you should see this, it says, just above my head, it says close by. That's where you close the position. And you can close the position by cancelling out the amount of long that you have. In this instance, we're long. So if we close, we have to take a corresponding short of the exact same amount. And we can do that via a market order. Show you this here. We can do that by a market order or a limit order. So that's how you close the order. You can do that right here. Or you can actually go up to the top and press close, and then you can close long. Now, I can't close any shorts because I don't have any shorts, right? So it knows, hey, you've got a long position. So you can close the long. Let's say I want to close 50% of it, I can do that. Right, I'll do that in a second. But this order, this take profit and this stop loss order is linked to our open position. So what I'm going to do is take that, stop loss out. I'm going to press cancel here, right here. So I'll just say cancel. That cancels that stop loss out. But of course, I still have my open position. Now from right here, what I'm going to do is close some amount of it. So you can do that down here by either a limit or a market order. Let's just choose market or limit right here. We'll choose limit, and it brings up the box and it says, how much of this order do you want to close? So you can close an amount of it. You can probably, with this small amount, you probably have to close the whole entire amount. And then you can choose a limit order. Now, if your limit order won't get hit, then that will just be in there as another order that you can put in. And then that will obviously get traded if you can. And then up here, you can do the same thing. So close, you can close the order, close long, and you can use either market or limit order right here. And that closes your position. So what I'm going to do is go down to close by. I'm going to press market like this. And it says, how much of the order do you want to get out of? So if you've got a big order and you want to realize some profits, you can just say 20% of the order I'm going to get out of. But we'll go to 100%. And then we'll press confirm. That's a market order, that's out. So our long position is now out. Whatever the profit and loss was and your trading fees and everything like that, that gets exchanged. Now you're out, and the profit and loss, whatever that is, that will go back into your unified trading account balance. Before looking at a sample short position, we'll go over how leverage affects risk. So with 2x leverage, all you're saying here with a long position is that I want to open a $100 value trade. So 2x leverage is I put $50 down. That means that from this price that we're trading at, I have a $50 margin here that the price can fall to that I can fund with my cash, and I won't get liquidated. But if it goes down more than 50%, I'm liquidated because I don't have the cash to pay for the loss. Now, if I change to 3x leverage, so we'll go to 3 here, all this does is it changes, well, firstly, it changes the size of the max size of the potential value in the market that we can trade. But if you trade the same size, 0.01, the $100 trade, I'm just putting less down in the trade at this point. So I'm leveraging 3x, which means the amount I put down is now $33. And so the same trade with more leverage stops me out here, 33% move. So have I increased the risk of the trade? Maybe, because you now can't fund a bigger loss to the downside. But if you have a stop loss up here anyway, if your stop loss is, up here, then 3x leverage isn't increasing the risk in your trade if you have a stop loss in above the actual liquidation point. It's not increasing the risk because you would stop out of your trade before the trade would be liquidated, right? So it's not increasing risk if you have a stop loss. If you don't have a stop loss, you are increasing the risk of liquidation, mathematically so, even though it's quite far away. Now, if we go to, let's say 5x, like this, that's a 20% move, right? So we'll go 20% move. If the mouse works, right, that would be something like this, right? Now that's increasing the risk a bit further because a 20% move in Bitcoin, it's quite likely. And so, yeah, you're increasing risk here, the more leverage you take, because you can't afford to fund a larger volatility move. However, again, if your stop loss is up here, you haven't increased risk. So it does matter what your entry price is and what your stop loss price is if you have one. And you just have to make sure that your stop loss is within the liquidation. You don't want to get down here and get liquidated. So if your stop loss is up here, you're not increasing risk as long as the liquidation price is away from your stop loss. And so you can just tie up less money into the trade if that's what you want to do. But of course, if you're trading with a 10% stop loss in Bitcoin, the volatility of Bitcoin is going to stop you out most likely. And so you just have to figure out what's the volatility of the asset. Bitcoin's like a 50, 60 vol. And so during a bull market, you could easily get 30% drawdowns, right? During a bear market, you get 50, 60, maybe 70% drawdowns. So you have to figure that in. You have to know what the volatility of the asset is. You have to figure that out. And that's going to dictate how much leverage that you think is actually normal to trade. Of course, if you're just speculating and you want to take a lot of leverage and you let's say you have 10 trades in a bull market and you don't mind if 3 or 4 of them get liquidated because that's just kind of trading money, then that's fine, right? But to be a little bit more professional about that, if you think you can get a 30% drawdown in a position, why would you want to get stopped out at 30%? Why not give yourself 40 or 50%, and then actually have some assets in the side that could fund that position so you don't get stopped out? That's all for the individual to figure out. But that's how leverage works. It doesn't necessarily increase risk. It increases risk if you start trading on high leverage. So I have, let's say that, $50 balance or something, right? So 3x leverage, I can open a $500 trade on this. Now let's go a bit higher. Let's do 10x leverage. We'll press confirm. The max trade that I can now enter is almost $2,000. But with 10x leverage, I've got a $2,000 trade and I've got $200 in cash to pay for that, which means that we're going to get stopped out right around here, which is just increasing the risk of loss for sure, right? So that's up to the individual to figure out how much risk you're willing to take, how much leverage that you're willing to take, if you want to take any at all. Now let's look at a sample short position whilst trading USD funded contracts. So open, market order, I'm just going to trade this value here. So 200 value is 100 cost because I'm using 2x leverage. So I'm going to open short this time. It's going to give me the details, press confirm. So what I'm doing now is taking a short position, which means that I've actually sold first, basically. I've sold it. So I have to buy this thing back if I want to close the position. Now, the risk on shorts is, from a technical standpoint, much, much higher because, like I said in the margin section, when you're short and you've sold here, you can only buy back at basically zero. But the loss is unlimited because this thing can potentially rise to infinity and you are going to get seriously hurt as the price rises. So with a short position, you're actually selling first, looking to buy back at a lower price. So you could have done that here. As we got rejected, you take a short position and then you can try and buy back lower. But using USD funded contracts here, this is simply a speculation on the price. So you can see I've got the Bitcoin USD. It's red to indicate a short position, my entry price and mark price, unrealized P&L, etc. Exactly the opposite of the long position. Now, if you're taking a stop loss order here, so let's add a stop loss. The stop loss is now going to be above the price because you're short and you get wrecked as the price moves up. and your stop loss would actually be buying back at a higher price. So you've effectively bought high and sold low, even though you've done it reverse. So the stop loss would be something like that, or whatever it is. Put that in, that stop loss would be in above the price to get out of your position. So yeah, there's more risk here. When you're trading USD margin contracts, and if you're using just USD to short the price of something, there is no other name for that other than just pure price speculation. Now, again, that's fine if you want to do that, right? But it's just speculating literally on, I'm going to short the asset, try and buy it back lower, and I'm using dollars to do that. The other way to do this is known as hedging your position, which I'll go through in a second, but that's a short position. So I want to get out of this one. Don't really recommend shorting massive growth assets too much or too regularly, right? But sometimes in a bear market, it could be something that you might want to do. In any case, we're going to get out of that position. We're actually going to buy back the position right here. Now, if I had that position open up here, I'd press close. And because I had a short position, it would actually be green, known as close short, because we have to take a corresponding long position to cancel out our short. Now let's move on to trading coin margin contracts, or as Bybit calls them, inverse contracts. So that's trade futures inverse up here. And I'm going to be trading Bitcoin inverse or Bitcoin coin margin. Notice how it's just Bitcoin USD now. We're trading inverse perpetuals. And on the right-hand side, we're going to open a trade here. But notice how my margin balance is now valued in Bitcoin and not dollars, or not USDC. It's not the dollar value of anything. It's Bitcoin, and we're trading in Bitcoin, and we're making profits and losses in Bitcoin. Now, like I said, there's some nuances here. You're increasing the volatility because you have risk asset collateral, which moves up and down in value, and you're taking positions against that collateral. So on the long side, if you're long Bitcoin with Bitcoin collateral, if the price moves up, you are making exponential gains. Your collateral is gaining in value in dollars because you're trading Bitcoin dollars. That's gaining value. And your position with potentially leverage is gaining value as well. That's ideal scenario in a bull market. Now, to the downside, that works against you because you've got Bitcoin collateral, you've got your position and you're long, and your collateral is moving down and your position is moving down. It's insane. It's a quicker liquidation, right? So there's extra volatility here that can be used, which is, good and bad in different ways. Now, the other thing you can do with this is when you take short positions here, right? We're using Bitcoin as collateral here. So why would you use Bitcoin as collateral to fund a short trade and a sell in Bitcoin? Well, this is how traders hedge their exposure. So let's say you think we're going into a bear market and you think the price is going to go lower, but you've got Bitcoin, right? So what are your options here? You can sell the Bitcoin and try and buy back lower, but that's a nightmare. Firstly, you don't sell your Bitcoin, right? You don't sell your Bitcoin because Bitcoin is an asset, and honestly though, people don't sell assets, right? You don't sell assets. If you sell the asset, you're gonna have a capital gains tax liability, so you're gonna have to work all that out. Then you've sold the asset for cash. What are you gonna do with the cash? Do you need the cash? Do you want the cash there? Are you gonna wait around and try and buy back? And especially if you've got a decent chunk of Bitcoin, I mean, what are you gonna do with the cash there, right? You're gonna put it back to a bank or, right, it's just a nightmare. So trade around the edges if you need, and you can hedge your position. So if you've got Bitcoin collateral and you think that this thing is going to go into a bear market and it might go down 50%, what can I do? Can I just sit on the loss? Well, you can potentially trade a portion of your portfolio and use the Bitcoin as collateral to create a short trade on the price of Bitcoin. That hedges your exposure. Yes, your Bitcoin is going to go down in value, but your short trade is going to win. And that cancels out the loss that you've got on the Bitcoin moving down because your account will be making a profit. The equity of your account as you're making a win in that trade will increase the equity of your portfolio. So you've basically hedged your exposure to Bitcoin to the downside in that case. The flip side of that is that if you get the trade wrong and you're using Bitcoin collateral and you shorted the asset, then as your Bitcoin moves up, the asset is actually moving up as well, which means your short trade is losing. And so it's canceling out the win of the Bitcoin here. And so the downside of hedging is if you get it wrong, you're missing out on upside. And if you're using a lot of leverage, then you can actually still get into trouble because the leverage is going to be making exponential losses, whereas your Bitcoin is only moving up its dollar value in spot. So it's something to be aware of, right? So there's risk with all of this for sure. So let's go over a long trade right now. I'm going to use cross margin, but anyway, it's Bitcoin. I'm trading the Bitcoin pair, 2x leverage, fine. And we're going to open an amount of this BTC. This is the quantity in dollars. This is the cost for me in Bitcoin. I'm using Bitcoin to margin here. We'll just open a market order, buy long. This is the details. This is the cost and value in actual Bitcoin here. Press confirm. Order has been filled here. So Bitcoin USD, 2x leverage. That's the quantity in dollars. That's the value in Bitcoin. Profit and losses are exchanged in Bitcoin here. So 2x leverage with Bitcoin. And if the price moves up, then we're using our Bitcoin to further leverage the Bitcoin price in a bull market. So that can increase the value of our trade and of the underlying Bitcoin. You've seen how to add take profit and stop loss orders here. So you need to work out here, if you get liquidated, what's the price? Now, luckily, Bybit do that for us, 50,000. However, this can change dependent on the value of your trade and the value of your collateral, because this can change. You see it changing a little bit over time. This may change if the price comes down and you're using a load of leverage. This can change the liquidation price. So just be really wary of, is that liquidation price okay? Am I happy with that? Now, if you're not, you can transfer assets from your spot account, transfer some Bitcoin in, and you basically are paying for the leverage, right? So you're actually reducing leverage there. So you can take this order. If it doesn't work out, then you can actually pay off the trade a little bit, keep the trade running a bit longer if that's what you want, if you have some Bitcoin. So I actually think coin margin futures give the existing traders a lot more options here. Because if you've got assets to begin with, you trade around the edges, and it actually reduces the volatility. So yes, using Bitcoin as the collateral can increase volatility, but if you're trading a small amount of your Bitcoin stack, then you can kind of move around assets and make sure that you don't get liquidated too quickly or anything like that. So there's a few more options here. In any case, we're now long. We're exponentially long the asset. In a bull market, that's great. So we can market close this 100% confirm. And that just moves all of the collateral back into our unified trading account. Now let's look at a sample short trade, and this would be hedging our Bitcoin exposure. So cross margin, 2x leverage, market order. Let's just do a sample short trade here and then sell short. You can see the cost and value. Sell short, press OK. And then down here, you can see the trade details. So the liquidation price is miles away. And that's because we're only 2x leveraged and we have Bitcoin here to fund. So we're short. So we need the price to go down for our trade to actually make money. But if the price moves up, we'll be losing money in that short trade, but our collateral, Bitcoin, is going to be moving up in price, paying for it. And that's why the liquidation price is so much further away. So this would be used with Bitcoin as collateral simply as a hedge against your spot holdings of Bitcoin if you think the price is going to fall down. So what we're going to do is market close that. So close by, market order, 100%, press confirm. And whatever's left goes back into your unified trading account in Bitcoin. Moving on from that hedge trade, now we'll look at a delta neutral trade, which you can carry out in futures markets. So back in the Earn section, I described what USDe does, which is Athena USD, where they carry out a delta neutral strategy in the futures market. So they go and buy Bitcoin and ETH in the spot market. They sell the exact same amount in the futures market short, and they hedge out their long exposure. So they have actually which should be delta neutral, meaning no price exposure. One wins, one loses. On a net basis, you should have the same amount of value. That's known as delta neutral trade. And so they use that to issue a stable coin where you give them $1,000. They have $1,000 liability to you to pay back at some point in the future when you call that. And meanwhile, they carry out this delta neutral trade where they should at all points have that $1,000 value to be able to liquidate to pay you back and pay your liability, right? And so what they're doing is paying an interest or a yield on top of that stablecoin liability. Why? It's because they are carrying out delta neutral arbitrage, which is where you take advantage of the funding fees in futures markets. Remember in the funding fee section, I said that funding fees are paid in futures markets. Now, most of the time, funding fees are positive, which means longs pay the futures funding fee and shorts receive the futures funding fee. So if they've got 1 ETH long and 1 ETH short, they have the same amount of cash, but they're earning futures funding fees. You can do this on Bybit yourself. Now, you can just put money into Athena if you want. Again, buyer beware, I'm not promoting it. some trading platforms actually let you carry out this strategy with a trading bot, which is you just press a button and it lets you do it. On Bybit, I think we have to do it manually for now, although they may have one actually. I'll go through that in the box section if it's there. So for right here, what I'm doing is trading the inverse, futures inverse, and I'm trading ETH USD. The reason why is because Ethereum, we can use a staked version of Ethereum to carry out this trade. The staked version of Ethereum that I'm using is staked ETH, ST-ETH. I have this in my account, and staked ETH is 1-for-1 with the value of ETH, but that coin receives staking rewards from the Ethereum blockchain, which currently at the moment I think is around 3% or something like that. So we've got this collateral in our account, and you can see the margin balance shows me that I've got 0.5 ETH. This is actually staked ETH in my unified trading account, ST-ETH. You can go and stake, like in the Earn section, I showed you how to stake assets. So you can stake your ETH for staked ETH. You have staked ETH, that's a coin in your account, move that over to a unified trading account. Now you've got the price volatility of ETH plus the staking rewards. What I'm going to do is go and carry out a delta neutral strategy, and I'm going to take a short position in ETH with my staked ETH collateral. So we go to order here. Now you can use a bit of leverage here, because if the short loses and the price moves up, your collateral is going to be moving up as well. However, the more leverage that you use, it could potentially move down your liquidation price. I'm just going to show you very simply with 3x leverage. Press confirm there. I'm going to open up a market order. So I'll just show you this. The quantity here. Let's do not a crazy amount. I won't do the whole entire amount, but I'll just show you this short position. So market order, 2x leverage, order by value. We'll sell short here like this. And we'll press confirm. Now what we've got is a delta neutral trade for this asset. So the amount, you're going to have to work this out manually of how much of your ETH you want to hedge in this way. But what this is doing is I've got the ETH as collateral. It's earning 3% from ETH yield, and it's earning funding fees as well. So whatever that is on top, I'm hedged out. So if ETH moves up in price, I'm still earning some fees and staking rewards, but I've missed out on the upside. So I've basically got a dollar value here, whereas ETH is going to cancel itself out, but I'm earning the fees. Now you may want to do this if you just want to earn some yield on basically dollars and you don't want the price volatility of ETH anymore. Now there's some downsides to this, is that in a bull market, you definitely don't want to be delta neutral on ETH. You want to be long the asset as it's going up in price. In a bear market, then you may want to carry this out so that you can try and reduce any potential losses from your assets through the hedge on the short side, and you keep earning the rewards as well. For most people, do you really want to do it? Because you're probably earning what, 5, 6, 7%, which you can put a stable coin somewhere and earn that anyway. Let's look at the funding fees though. So we'll go to the funding fees up here. We go to derivatives info, trading data, past funding fee. We'll look at this. We'll go to Ethereum. So we need to find Ethereum here. This one. You can see the funding fee is at 0.01%, exchanged every 8 hours. Work it out as an annual figure. It looks to be positive for the most part, so we would be receiving those funding fees being short. But that is how to carry out a delta neutral trade. I've got staked ETH as collateral. I'm taking a short position in ETH. And so if the price goes down, great news. If the price goes up, you're missing out on the upside, but you are still getting the rewards. So you're basically creating a dollar asset with some yield on top of it manually. But there are protocols that do this where you just give them the dollars and then they do it for you as well. But again, I don't want to promote those. In any case, we'll close this one. Actually made some profit on that short. So market, close, confirm, that's it. So that is how you take a delta neutral trade whilst earning either funding fees and or staking rewards from proof of stake assets. Now I'll show you Bybit Web3, which is Bybit's way of letting you access applications on blockchains and all of the assets on various blockchains. So this is kind of a middle ground. You have centralized exchanges, which are totally centralized. You put your assets into the centralized exchange, you give them custody of them, you trade them around, and then you withdraw them. Right? With blockchains are financial operating systems. So anyone can issue an asset, and anyone can make an application on there that you can use. But the applications are all the same thing: lending, borrowing, staking, trading, and derivatives. That's all you can do with assets. So you can either use a centralized exchange, or if you want to use a blockchain, you're more comfortable with that, you can use that as well. So with Bybit Web3, they create a wallet for you, and it make it way easier to use blockchain applications. Now, you can also use blockchain applications yourself by getting your own wallet, either a software wallet or a hardware wallet, using that yourself, going to the website of the application you want to use, connecting your wallet and trading. You can do that yourself. Bybit Web3, though, is what is Bybit? It's a financial platform that helps you do things. So with Bybit Web3, they're just trying to help you use blockchains in a certain way. Now, you can see I'm connected here already. I have a cloud wallet. Cloud wallet is what Bybit call the wallet that they create for you. They create blockchain wallets for you so that you can use applications. However, they keep the keys to this wallet. So this is not self-custody. Self-custody is where you own a wallet and you keep the private key to that wallet, and only you have it, and that means you own the assets of that wallet. With Bybit Web3, they create a wallet for you, but they keep the keys. So this is their custody of the assets, but they can't manipulate the assets in the wallet. They just keep the keys to it and let you access the blockchain. So it's kind of a middle ground solution. It's not full self-custody, but it's not a centralized exchange. Now from here, what can you do with money, or what can you do with assets? Trade, lend, borrow, stake, and trade prices of them. That's pretty much what you can do, right? So that's what this lets you do as well. But the difference is you're doing it with direct access to blockchains, which have all the assets and all the different applications. So with Bybit Web3, we'll go over to receive, and we'll choose ETH. That's my wallet address. So if you want to send ETH into your Bybit Web3 wallet from another exchange or your own wallet, or if you want to send out from this wallet to your own wallet or another exchange, then this is your blockchain wallet here for your Bybit Web3 wallet, and you can just send it in. Or if you want to send out, just press send, and it will say, well, where do you want to send? This is my Bybit Cloud wallet. These are all of my assets. What do you want to do? This is an asset that I have, so I want to withdraw that. And it says, okay, you want to send out, where do you want to send it? So you can put the receiving address, another exchange, your own wallet, something like that. Or you can very easily link it to your Bybit centralized exchange account if you want. So I can send right here to my Bybit funding account, press that, and I can just send it out. Whenever you use a blockchain, and when you use blockchains, you have to be aware of what you're doing. You're using a blockchain, which means you're not using a centralized exchange. A blockchain charges fees when interacting with the blockchain. So if you want to send assets, if you want to trade, you have to pay a fee to the blockchain to actually go ahead and do that, which means that whenever you use a blockchain, you need some of the layer 1 coin to pay for fees. So on Ethereum, and all the other Ethereum chains, you have to use ETH for gas. So you want to use a chain, you have to get some Ethereum, you have to put it into your blockchain wallet to pay for gas fees. If you're using Solana, you need Sol for gas fees and so on. Bitcoin obviously uses Bitcoin for those fees as well. If you need to know a lot more about using blockchains and wallets and everything like that, I'll leave some videos below because it's a massive video in itself. But let's say you set up a cloud wallet and you want to go ahead and use it. Go up to the top and we're going to trade. We go to swap, and this is basically like the convert feature on the Bybit exchange. So I want to swap one asset for another. I'm going to say that I have assets on the base chain and I've got some ETH here, and I'm going to swap it into the same chain, obviously, because we need to use the same chain. And I'm going to search to swap into USDC. And we have USDC here. So if you've got assets in your blockchain wallet and you want to swap them, swap ETH for USDC on the base chain, that will go through. I don't know what the trading fees are here, but I assume they're way higher than the centralized exchange. But again, what are gas fees? You have to pay gas fees on blockchains. That is swapping assets. If you go to DEX Pro, this is simply the Bybit spot trading screen. Only we're not trading on the Bybit centralized exchange, we're trading on blockchains instead. So each blockchain has its own set of assets. So let's see all right here. These are done by trading volume, I presume. But let's go to the Solana network. These are popular tokens on the Solana network, as you can see. These are popular tokens on the Base network. These are popular tokens on BNB chain and Ethereum. And so, you can just search for the assets you want to trade. Let's say we want to actually go ahead and buy this asset. Over in the right-hand corner, you can see buy and sell. So I want to buy an amount of Ondo. You can put an amount in here, and then you would pay. Usually you pay with the layer 1 coin potentially, or if you've got some other assets here. So let's say that on the Ethereum chain, I have some USDT. I can say that I pay in USDT and I buy Ondo, right? So that's another token. Or you can sell Ondo into USDT. So look, this is exactly like the Bybit spot trading screen. You're swapping one token for another. The only difference is we're using a blockchain directly. So if you want to use the Ethereum chain, you have to pay gas fees on Ethereum, and you need gas fees in your Ethereum wallet. If you want to use the Solana chain to go ahead and trade, you have a Solana wallet address, get some SOL from your Bybit exchange or any other exchange that you use. If you want to send it into your Web3 wallet, you just send it in, you have Solana on the Solana blockchain, that's used to pay for gas fees. And then up here, let's say that we want to trade this coin, probably a scam coin, right? It's insane, UFC is not official, right? But up here you can buy and sell, and then you can choose which asset that you use to actually go ahead and buy and sell. So it's exactly the same as trading on the spot market on Bybit. You're just trading on decentralized exchanges and on blockchains directly with the assets listed on there. Just like the Bybit centralized exchange, we can also trade futures in Bybit Web3. So go to trade here, and then it's ApeX, which is basically the Bybit futures trading system spun out of Bybit and put on the blockchain. And so this is its separate application because it's a blockchain app. And the way that you log into the app is through your wallet. So I'm already connected right here, but up at the top, it would say connect or recover keys, and you can just log in with your Bybit Web3 wallet. That lets you trade futures on the blockchain rather than on the centralized exchange. So you can go to apex.exchange as well. I'll link them below. You can get a permanent fee discount. So if you connect your own wallet, you get a permanent fee discount that you trade with that wallet. What I do is actually set up my own wallet. So Bybit Cloud Wallet is fine if you use the Bybit centralized exchange, but I don't think you can set it up without an exchange account. I set up my own wallets like Rabby or MetaMask, something like that. My own wallet with my own keys, I take self-custody. I just send assets into that from Bybit, and then I can use a blockchain application. So I can log in directly to Apex, can trade futures on here, or I can log into any other application pretty easily. Bybit Web3 does let you do that very easily if you don't want to manage your own wallet and manage your own keys. But this is a way to trade futures on the blockchain. And this is the way that a lot of exchanges are going, right? You can see what's happening here. You can trade futures, you can trade on DEX Pro directly on the blockchain. And that means that you don't need to use centralized exchanges, and you can have access to a lot more applications with your money if you want to. So that's how to use blockchain wallets and Web3 with Bybit Web3. But it gets way more complex and deep in the weeds if you want. So I'll leave some videos below on how to use Apex Exchange, how to use blockchain wallets, how to set them up, how to manage your own keys, and then how to use different DeFi applications. So I'll leave all of that in the separate videos linked below. Now we'll look at trading options on Bybit. And options are a complex topic and worthy of a 2 to 3 hour video in themselves. But I'll go over the basics of what options are and how they help us trade. Options are, as the name suggests, an option to do something in the future. And obviously with financial assets, there's only two things you can do with a financial asset. You can either buy it or you can sell it, right? And so the option to buy it or the option to sell it in the future. Instead of trading right now in the spot market, where if you want to buy something, you have to immediately settle and exchange the assets, with options, you are negotiating a contract with the other side of your trade for the option to do something in the future. So let's see what an option is. What is an option? It's an option, but not obligation, to buy or sell something in the future. So it's a contract between you and the other guy to buy or sell something in the future. And so a buy option is called a call option. That is the right to buy in the future. A sell option, the right to sell in the future, is known as a put option. So you have call options and put options, buys and sells. Now, when you negotiate a contract with someone in the future to buy or sell something, there are certain parameters of the contract that you need to negotiate and settle on. So one of them is the expiration date of the option, right? So I can't ask you, hey, I want to buy your Bitcoin in the future. And you say, yeah, sure. Well, that's not going to work, is it? So if I say, I want to buy your Bitcoin in the future, what we have to do is figure out, well, when does that option expire? So just the date, right? What's the expiry date of our contract? And also, what price are we going to go negotiate for that, right? Because I can't say to you, hey, can I buy Bitcoin in the future? And then, we don't negotiate anything. A month later, I say, hey, I've come to buy my Bitcoin and I want to pay $1 per Bitcoin. Well, we didn't negotiate any contract, right? So when you negotiate a contract, you need the expiry date for that contract. You need the price at which you may exchange in the future. And then also part of that is the premium. So think of options a little bit like insurance. They can be insurance if you buy them, right? So if you have insurance, you are going to the insurance company and saying, in the future, I want the option to get money from you, right? Because if I crash my car, I want the option to claim an insurance claim from you and claim money to pay for it. I may not claim that option, I may not exercise that option, but I want the option from you to do that in the future. And the insurance company is going to say, absolutely. However, you need to pay us a fee. And I'm sure all heard of insurance premiums, right? It's the same thing. You're paying a premium to the insurance company as an incentive for them to give you the option to do something in the future, which is get money from them at a certain price or whatever. So they're really the parts of an option, which is the strike price needs to be negotiated, the expiration date of that option needs to be negotiated, and then the premium for this contract has to be negotiated as well. And that's open to supply and demand in the market because these options trade in the market. And so the premium is important because it helps price the option. Because when an option is created, you need a strike price. But when the price of the underlying asset moves, then that strike price could actually be more or less attractive. And the way that we price the option once it's been created is by changing the premium, the fee paid to either buy or sell the option. Options premiums are really the important thing to focus on when trading options, especially when trading crypto options, because that's really what we're trading here. We're trading the premium itself, and the premium has a price. And if we think that price is attractive, we may buy it. If we think it's not, we may sell it. And so it's really the premium that's important, and especially for crypto options, because what they do is they don't actually make you deliver the asset when you trade the options, right? So let's say that I give someone the option to buy my Bitcoin in the future, and they call me on the option, and I have to deliver that Bitcoin to them because I've negotiated the contract, and they say, hey, I'm calling the option, give me Bitcoin. That's not how it works on crypto exchanges. What they do is just exchange the balance between when you bought and sell the option or when the option expires. And if there's a profit or loss, it just gets exchanged. So you actually exchange the balance of your profit and loss in US dollars instead of actually having to settle the underlying asset. In any case, we're trading the options here. And so the options are a cost if we buy the option, but they're also an income if we sell the option. So an option is the option to buy or sell in the future. So like I said, you have a call option and you have a put option. Well, I can buy calls, right? I can pay someone a fee for the right to buy their Bitcoin in the future. Just like buying insurance, right? I can say, here's my money, and in the future, I can buy your Bitcoin at a certain price if I want. So I'm paying that premium. But the other side is the writer of the option. They actually receive my premium. So you can buy calls and you can sell calls. Selling calls or selling options is known as writing the option. And if you buy the call, you pay a premium. If you write the option and sell the call, you receive the premium. And so you receive a fee here. So that's important because you can use these options to actually generate income around your assets and your portfolio by writing options. So the put side is that you can buy a put, which is buying the right to sell at a certain price in the future. And so that's exactly like buying insurance, right? I want to pay a premium now for the right to sell in the future. So if the price goes down a lot, I'm actually going to sell at a higher price because I've locked in that option. But you can also sell a put, which means that you can receive the premium, and that means you're gaining income from selling that put. But there's risks here, right? Because if the options buyer calls the option, that means that you have to do that thing, which is either selling them Bitcoin or buying Bitcoin from them. So when you write options, you receive a premium. It's a fee paid to you by the buyer of your option. You can go ahead and do that on Bybit. If you want to write options, you can do that and you can receive premiums. And if you buy the options, you have to pay that premium. The premium is a fee, right? It's a fee paid, but it's often touted as a yield. Like I showed you in the earn section, you saw those more complex ways of earning very high yields. That's not real yield. You're actually trading options in those products, and they're just looking at the premium that you may get paid, and they're taking that as an annualized figure. That's not how it works, because with an option, there's an expiry date. And so over a week period, you may get paid a premium, and that's pretty good, but you're not going to get paid that every single week for the whole year. And so it's not really a yield like you would get in lending or anything. But yes, you can earn income around your portfolio by writing options, getting premiums. The downside of that is if the option is called, then you have to do something. And usually if the option is called, it means it's because you made a wrong decision, right? So if you let someone buy Bitcoin from you in the future and they actually exercise that option, that means that the price is higher, right? Because no one would exercise an option to buy Bitcoin at 100,000 if the price is 50,000. But if they bought the option from you to buy Bitcoin at 100,000 and the price is now 150,000, they can buy it from you at 100, which they're going to do, which means you made the wrong decision selling that call, because you could have held on to the Bitcoin and held on and sold it for 150,000 later. So I'll go through that in a second, but that's options, right? You can receive premiums or you can pay premiums, but they're exchanged between buyer and seller of the option, or the option holder and the option writer. If we go back to the trading screen, what you can see here is a market for call options and a market for put options. So you can buy or sell the right to buy, and you can buy or sell the right to sell. On the left-hand side, so we're on Bitcoin options here. I'll just give you this expiry date. So that's the expiry date that we're looking at. And in here, we have the strike price. So this is the price of the option. And what we can see is that these are calls on the left-hand side, and on the right-hand side, these are puts. So we have a market for calls and a market for puts. So this is the bid and offer, or the bid and ask for calls. So these are buyers of calls. These are selling calls. Over here, we have buyers of puts and sellers of puts. And they're a market, a bid and offer, just like in the spot market. And in the middle is the mark price of the premium. And that is what you're trading, and that changes over time dependent on the spot price of Bitcoin and the strike price of the option. So what we can see here, if we scroll down, this right here is pretty obvious that this is the price of Bitcoin right now. So this is the price of Bitcoin right now. And we can see that these options here above this have been written when Bitcoin was a lower price, right? And so you can see that the strike price for this option is 103,000, 102,500, 102,000, and so on. These options were written when Bitcoin was lower probably, and Bitcoin is now higher than those. So this is free money, right? Because you can just buy an option for 102, buy the right to buy it. You can buy a call option at 102, and the price is 104 now. You can make free money. Obviously not. This is where the premium comes in. The premium changes to take account for the current price of the asset, so that basically you don't make any free money. Arbitrageurs will come in and make sure that the options are priced correctly. So if you've got a call option at 103,000 and the price of Bitcoin is now about 105, then it makes sense that the premium paid is going to be around 2,000 to basically not give you any free money if you bought the option, right? So the strike price is 103,000, but the premium is 2,000 on top. And you can see that actually the mark price, so the premium plus the strike price, which would be the cost if we bought the option, which is the strike price plus the premium that we pay, it is actually slightly above the current price. Why is that? It's because there's still some time before this option expires, which means you have to pay for some of that, right? You get nothing for free in this world. So if a strike price is below the current price, that means the option will make up for it by being more expensive. If this actual price of the asset falls, this premium will get cheaper because it has to price in the fact that this option is not really worth as much anymore because the price is lower. You can just go out in the market and buy it. So what we need to do is figure out where the price is and where these option strikes are. When an option's strike price is cheaper than the market price for a call option, that's known as in the money. You're in the money because the strike price is below the actual traded price of the asset in the spot market. When you're right here, close to it, that's known as at the money. And when you're more expensive for a call option, that's known as out the money, right? So this is in the money. This is out the money. This is at the money for a call option. It's actually the opposite way for a put option. So a put option would be out the money right here below the current price. Because why would you buy the option to sell Bitcoin at 102,000 now when the price is 104? You just sell it now. So these are out the money. These are at the money, and then these are in the money. Because I would love to sell Bitcoin at 107 now, considering it's 104. I could buy 104 in the spot market, go and sell it for 107 in the option. Well, you're not going to be able to do that, right? So what happens is you can see the premiums start to get more expensive here because these are in the money, right? You can't make free money, so you have to pay way more for the option. You can see there's a perfect correlation here, right? So these are in the money for call options because they're too cheap. These are in the money for put options because they're too expensive. And either side, you get cheaper premiums because, why would you want to trade those? And why would you want to trade these? So of course there is opportunity there as well. If you think options are mispriced, you think the price is going to move in a certain way, then you could potentially make some money from buying cheap options to do something in the future. But in the money, the strike price will be in a profit. Out the money, the strike price will be in a loss. And at the money is where the strike price is, or the closest strike price to the actual underlying spot trading price right now. Options are a zero-sum game, meaning there is a winner and a loser in the trade. So if you win the trade, the other side actually loses out the exact same amount as well. So let's go through some examples. Let's say we're buying a call option, and a call option is the right to buy Bitcoin in the future. So the strike price of that call option is 20,000 and the premium is 200. And the market price now is 19,000. So if I want to buy the call option, I have to pay $200 premium in order for the right to buy Bitcoin in the future at 20,000. Now that's an out the money call option, right? Because the current market price is 19,000. So that strike price is out the money, but I still have to pay a premium to actually get the option to do that in the future. Now, the expiry price for the option is 22,000. That means that the buyer of the call option is going to exercise. Why? It's because his cost basis is the strike price of the option, 20,000, plus the premium, 200. So his cost basis for that Bitcoin is 20,200. And the current market price is 22,000, which means he will exercise the call option. He'll pay 20,000 to the seller of the call, plus the premium of 200. And he'll go out and sell the Bitcoin in the market at 22,000 and pocket the difference, which is $1,800. Now, the other side of that, which is the seller of the call option, the guy that actually sold the option to do that, he needs to deliver that Bitcoin at the contractual price of 20,000. So he needs to deliver Bitcoin at 20,000. But he lost out because if he didn't do that, he could now sell the Bitcoin at 22,000, which means that his loss is 1,800 versus not having to do it, right? So he lost that out. So that's obviously a loss for him. However, it's not the end of the world, right? If this guy bought Bitcoin at a very low price and he was selling call options, getting premiums in, he may be okay with selling at 20,000 versus 22,000, right? And so what he's trying to do is, just sell some calls and get some income. And you know what? If he sells some, then not the end of the world. But just from a technical perspective, for sure, you can see it's a zero-sum game. So he wins out of that trade and he loses the exact same amount versus if this guy never went into the options contract. So that's the call option example where the buyer will actually call the option and he will simply make that profit when he can sell the Bitcoin at the expiry price, which is the price in the market as it is. Or he doesn't have to sell it. He can just buy the Bitcoin and obviously not sell it. But on Bybit, you will actually just exchange the balance of the profit or the loss when the option expires. Now let's look at an example of a put option being the right to sell in the future. So if you buy puts, you're paying a premium and a fee for the right to sell in the future at a certain price. If you're selling those puts, you're giving someone the option to sell you Bitcoin in the future at a certain price, and you're receiving the premium. So again, the option strike price is 20,000, the premium is 200. This time though, the market price is 21,000, and the price at expiry is 18,000. So what do we have? We have a strike price of 20,000, which the market price is currently 21,000. So this put option is out the money, right? Because it's out the money. You can sell right now for 21,000, but you're buying the option to sell at 20,000. So you're buying something fairly cheaply out the money because you think the price may fall lower than that, and you want to lock in your price here and pay a small premium to do so. And so this is an out the money put. Now at expiry, the price is actually 18,000 below the strike price. So what's going to happen? The buyer of the option has the option to sell Bitcoin in the future at 20,000. The current price is 18. So he is going to exercise that option because he can sell at 20 and buy back at 18 and lock in his profit, or he can just sell at 20. But for this example, I want to show you the zero-sum nature of the game, which is if you're exchanging the balance of the strike price and the premium is if the strike price is 20 and the expiry date price is 18,000, then you would exercise the option. You would buy at 18 and sell at 20 immediately and lock in your profit. So you would buy the option and you would exercise the option. So you can get 20,000 for your Bitcoin and your cost basis is 18 to actually buy it in the market. And you have to minus off your premium as well that you paid. So you sell at 20,000, you go and buy back at 18. So you make 2,000 profit. but you have to minus off the 200 premium that you paid. So your net profit is 1,800. Now the seller of the put, what's happened to him? He needs to buy Bitcoin at 20,000 because this buyer actually exercised. So he has to essentially buy at 20,000 and then go and sell it for 18,000 in the market. So that's a $2,000 loss. Now for him, he may not sell in the market straight away. He may just actually buy the Bitcoin. But for a cash settled balance, right, he has to go out and buy Bitcoin at 20,000 and sell it for 18,000. So it's a $2,000 loss. However, he got the $200 premium from the buyer. And so his loss is not 2,000, but it's only 1,800. But you can see the win and the loss are the same. So it's a zero-sum game. One of the options traders wins and the other loses. When trading options on Bybit, we actually get payoff graphs that we can look at, which makes things a lot easier. But this is just the normal payoff graph for each of the types of trade you can make. So long calls or long puts when you buy the option here. So buying the right to buy, buying the right to sell, going long calls or puts. These are short calls and short puts, meaning you're selling the right to do something in the future and you're receiving premiums. So paying premiums, receiving premiums. Let's look at going long first. The cost of your trade when you buy an option is the premium. That's this right here. So immediately when you trade the option, you're paying the premium and that's the cost of your trade. The most you can lose is all of your premium that you paid. So if you don't call the option, it means that the price wasn't good. You paid the option premium, you'll never get that back. That was the cost of your trade and it's over. So that's the biggest loss you can make is the option price. This is the strike price right here. You only start making money when the market price moves above the strike price to the amount of the premium that you paid. So this is a strike price right here where it says X. Yeah. And so this is when the market price goes up enough to pay for the cost of your option. And then up here, you start making money. So you only make money when the market price goes to pay for the premium that you paid over and above the strike price, right? So strike price plus the premium here, and then you start making money. Now for puts as well, it's the same thing because you're buying the put, which means that this is your break even here, right? And so the cost of a put is the premium that you pay. If the price, this is the strike price here, right? And so if the asset actually goes up in value, then you don't exercise, right? And it doesn't matter because you only paid the option price here, the premium, right, which you paid. So you only lose your premium when you buy puts, which if the price goes up, you just lose your option premium. Now you only win when the price goes down enough where past the strike price, where it pays for your premium, then you start making money as the price falls past that. So when you buy options, you have a specific cost, which is the cost of the premium. You buy it and you'll never get that back. You only start making money when the price moves in your favor enough to pay off your premium, and then you start making money. But the reason why buying and selling is often used by people when trading options, or buying puts and calls, I should say, when trading options, is because you can put a small amount down and you can take leverage, right? So you can buy a call option, super bullish, you buy a call option, you only put a small amount down and potentially win big. And if you don't win, then you know exactly what the cost of your order is, which is your premium that you give up. When you write options or go short options, then you receive premiums. And the best outcome for you when you write options is that you receive the premium and don't get called on the option, right? So if you short calls, that is writing a call. So you're giving someone else the option to buy from you in the future. They're going to pay you the premium. That's what you receive and you always get that. This is the strike price right here. So you start losing money if the price rises, right? Because let's say you give them the option to buy at this strike price. Well, if the price gets to here, you're still going to be in the money because the loss that you're making between the strike price and the actual price is paid for by some of the premium. So you're still making money here, right? This right here, you're still making money between the strike and the break even, which is the strike price plus the option premiums that you got paid. However, if the actual market price starts to rise further, right here is when you start losing money, because despite getting the option premium, the price is so much higher than that those people are going to call you and you lost money versus not actually giving them that option. This also works on the other side when you go short puts or you sell puts. So again, you receive the options premium, which is fantastic. If the price rises, you keep that premium. So great news. However, if the price falls, then this is the strike price right here. As the price falls, you're going to be okay for a bit because the premium makes up for that. However, at some point, if the price falls far enough, all of the options premium gets taken out and the price falls further, you start losing money because you're now going to have to buy their Bitcoin at 20K here at this strike. But then down here, the price of Bitcoin went to like 15K, right? And so you've actually had to buy at 20K when you're going to have to sell out at 15K. You lose that difference. So with selling options, you receive the premiums. When you buy, you actually, pay the premium, and that is a cost to you. So the cost to the buyer is the income to the seller. But there's risks here that if you get called, you actually have to exchange the assets. But on Bybit, you just exchange the profit or loss in the trade. So why on earth trade all of these options then? Well, it's either speculation or it's hedging. So why would you buy a call? It's because you're bullish and you think the price is going to rise. So you want to spend a small amount now and wait for the price to rise, and then you can make profits in the future. With options, you can take leverage, so you can put a small amount down and potentially get a big payoff in the future. Why would you sell a call? It's because you're bearish and you think the price is going to go down and you want to receive the premium and not have to sell the asset. So this is known as either a short call or a covered call. Covered calls are when you actually own Bitcoin and you give someone the right to buy it in the future. Now, the worst case for you is that you receive premiums and you have to sell it in the future, so you make a small bit of a loss. But it's covered because you already have the asset. You can also just go short calls in dollars, which means you're basically shorting the price of the asset, which potentially means you make a big loss in the future if the price rises, and you have to cover that loss when you exchange the balances. Covered calls are less risky. That is a very common strategy of hedge funds where they own assets and they sell out the money call options just to try and get premiums to increase the amount of money they make. And if they do get called on them, well, they make a loss, but they don't get absolutely wrecked because they can just deliver the asset. Why would you go long or put? This is insurance. You're bearish on the price and you want to buy insurance to sell Bitcoin at a price in the future because you think it may go way lower. So you pay the premium out. It's like having insurance. Why would you go short or put? Well, you can either speculate on the price or you can hedge. So you receive premiums here. So if you actually do have dollars and you're like, you know what? I don't mind buying Bitcoin, but instead of just buying it in the market, I'm going to sell puts. And so if the price falls and I get called on the option, well, fine, I'll buy the Bitcoin at a slightly higher price than I could have, in a month's time. But I've received premiums as well. So this is kind of if you've got dollars and, maybe you want to receive some income on those dollars, then you can do that. And the downside is you may have to buy Bitcoin in the future. And if you do, you're buying it at a more expensive price than you could have in the future. Maybe you want to do that, or maybe you don't, right? That's up to the options trader. But these are why you would trade options. So you basically either speculate on the price or you hedge around a position and potentially get called on it, which may or may not be the end of the world for you, depending on what you want to buy and sell. Like I said, options are incredibly complex to trade. You can earn some premiums from them, but you can get caught out on the wrong side. If you're just buying options, then maybe that's a little bit less risky where you're basically either going to win or lose. I'll leave some other detailed videos on trading options and some of the different scenarios down in the description. Now I'll show you an overview of Bybit's trading bot system. And trading bots actually are not very intelligent things. These are just programs where you can tell the trading system to trade in a certain way. So actually they're no different to the order types that we looked at in the spot trading section with limit orders, iceberg orders, TWAP orders, other things like that. You're just telling the system, here's how I want to trade. Go ahead and do that within these parameters. And so they can't make you money if your instruction isn't the correct one to actually go ahead and make money. But there are different versions of these bots, so I'll go through them now. So firstly, the DCA bot, which we've already seen, I think, in the auto invest section. But if we press create here, this just lets you set an instruction to the system to buy a certain asset at regular intervals. So if you want to use either USDC or USDT, you select the cryptos that you want to buy, you select how much of it you want to buy, you can add in other cryptos here, and then you say each week, I just want you to buy this amount up to a limit of $1,000. So you're going to make 10 purchases of $100 each week over time for Bitcoin, and that's that. That is automating a dollar cost averaging strategy, which just buys at regular intervals. Now, actually, with BTC, that's really what you want to do. But again, it's just easier to log onto your trading system every week and for 10 seconds just make the purchase that you want. Because right here we don't really know what the trading fees are, and so it's better just go right to the spot trading system and do that yourself. It takes literally not even a minute each week to go ahead and dollar cost average into the assets that you want. Grid bots are quite popular, and the way that these work is that you give them a set parameter to work within, and they try and buy and sell at regular intervals. And attempting to buy and sell, make some profit, and you can actually withdraw that profit from the bot whilst leaving the bot running. Now, in my experience, this is not as profitable as simply just buying and holding and investing regularly in the asset itself. So taking Bitcoin as an example, I have grid bots that have been running for years at this point. For the channel, I make updates on grid bots and other bots and how they work for specific videos. And I've just set up a few bots and left them running literally for years to see, hey, do these things work? Do they outperform the actual asset? And the reality is that they have underperformed simply just smash buying Bitcoin each week. Because of the way they work, they actually reduce volatility rather than taking advantage of it, which may be a strategy that you want to implement, but it's not like buying and selling regularly is going to outperform actually just investing over the long term, adding and adding and adding to the best assets, and then eventually at some point in the future, then taking profits. So the way that these grids work, and I'll show you this, is that you set them a parameter to work within. So let's say I tell the bot that I want you to work within a price range of 96 to 100, and I'm going to give you $1,000 to trade with. Within that, I want you to trade every 50-cent move. Right, and so what it's going to do, it's going to go ahead and buy. Let's say the price is 98, so it buys. It then wants to put a sell order in at 98.5. Now, if the price moves back down to 98, it then buys some more at 98. If the price moves up to 99, or 98.5, it trades again. Now, if the price moves down to 98, and then it moves down to 97.5, it buys. It buys every 50 cents, right? Goes down to 97, it buys. Then the price moves up to 97.5, so it sells again. If it moves back up, then it sells this one here, sells that, and then if it moves up, it sells this one here. And then if it moves down again, it starts to refresh these bids, right? So it's supposed to just buy, sell, buy, sell, buy, sell the whole time in a grid. Each grid completed is a buy and a sell, and then that's obviously a profit that it takes out. And people think, well, I'll take this grid bot because I want to create income. I want to generate income from trading. And that does make sense. However, what is actually way more profitable in my experience, if you are looking at actual investment returns, is to keep buying the asset over time and wait and wait and wait for as long as possible. Just from my experience, that actually made, looking at the grid bots and what they made versus what it would have been to hold the asset and buy it over time, it underperformed that. The way that grid bots actually work and the way to use them is if you think that the price of the asset when you get in and start the bot will change, but then eventually you get out of the bot at the exact same price. So let's say you start the bot at 98. You want the thing to be really volatile in this range like this, but eventually you want to get out at that exact same price. That would make sense because versus just holding the asset, let's say you got in at 98, the thing went like this, and then it's 98 again and you sell out. You don't make any money whatsoever, right? Well, these bots would outperform that because it would have traded and made profits in and out of the volatility. So I would only use a grid bot if you think that the price you're starting the grid bot at will be volatile, but eventually come back to that price. That could work. But if the asset just goes higher and higher and higher over time, these grid bots are going to underperform it. And that's what I've seen in reality as well. Here's some data from a couple of grid bots that I had been running for about a year or so at the time of making the previous update video. And this is the data that I had. So I entered the Bitcoin grid bot at 39,400, the Ethereum grid bot at 3,000. Now, as you can see, lump sum investing when I had made that video, Bitcoin's up way more since then. Ethereum is actually down since this point, or basically flat. But in any case, lump sum made me 31% in the BTC. The grid bot made 31% with the buying and selling and everything like that. So it's not actually outperforming just smash buying the asset. But if I had dollar cost averaged the asset, so if I had just bought more each week, I would have got a 67% gain, which outperformed the grid bot. And it's the same for Ethereum here. Lump sum was down a little bit. Grid bot was actually up a little bit because it had been buying and selling the assets. right? So because lump sum was down, then yes, the grid bot outperformed because it was buying and selling the volatility and getting some assets out of it. But dollar cost averaging would have been plus 38. So yeah, the grid bots basically didn't outperform dollar cost averaging. They were kind of flat at the time because the price hadn't moved too much away from the entry prices. However, as prices move way up for the coins, the grid bot way underperforms. So it depends what you want, right? If you think the price is going to be volatile when you get in and then you get out at the same price, it can actually outperform. But then there's tax implications as well of buying and selling. You may have to report that and everything. So yeah, there is a specific use case for them within a trading scenario, but it's not like they're just going to outperform other strategies. You have to actually have that within yourself to say, what is going to happen? What do I think is going to happen? And do I want to use them? So spot grids and futures grids, same thing, but this uses futures, this uses spot. So I'll show you how to create these anyway. These are some previous bots that have run, and you can see the different strategies here because you need to essentially give the grid bot a price range to trade within. So this one here was within, let's say $90,000 to $110,000 Bitcoin as it is now, and it would trade within that price range. The reason being, if you just say trade, and I don't give you any parameters either side, then the amount of capital that you have has to be tied up within a specific amount of possible trades. So the wider the range that you give it, the less money it has per each grid. If you give it a tight range, it can trade much more size within that grid and more actively. So again, the parameters can change over time because again, you don't know what the volatility is going to be between when you get in and out. And so you have to, again, make that decision for yourself. But you give it some intervals here. So it's got 16 grids between this price. And that shows you that the profit per grid is around 1 to 1.5%, right? So the grids are about that far apart. And if you get in and out, that's a 1% move and you take that out as your profit. This has had very good profit, as you can see. But this is a moment in time and it depends when you get in, when you get out, and the volatility during that period versus just holding the asset over time may actually outperform this, right? So this has made money, but yes, outperforming this could have just been dollar cost averaging the asset. So if you want to get in, you just give them an amount that you want to get in to trade with, and that will put this money within this range to trade with. In my experience, the way that they work best is that you should get in, you should think that the crypto asset, when you start the bot and when you finish the bot, should be around the same price. In that way, you can then make money out of volatility. And that's going to outperform because if you just buy the asset, you're buying at this price and the price is here, you actually haven't made any returns, although you still own the asset, right? But you haven't made any returns versus a grid bot, which could have. So that's where it outperforms. But it's a very specific strategy that, the hit rate on that may be quite low because how do you know what's going to happen during that time? But if you have an idea that, hey, you know what? I think the price isn't going to move much between now and later, then you can go into a grid bot. But again, it may open up tax implications as well from buying and selling a lot. So they can work, but they're not this amazing thing that's going to suddenly make money more than just actually investing in assets anyway. The other type of bot that Bybit provides is a martingale bot, and this just helps us with a specific trading strategy. It's an active trading strategy where you think that the price will dip and you want to get decent entries during that dip, and then as the price moves up again, you want to sell at some point. And that's what the bot does. So the way this works is you set the parameters to say, I want to buy at intervals in a drawdown. So you think the price is going to dip. So what you do is you buy at certain price intervals. Now, you could just use limit orders, right? So you think the price is going to dip down and you can say, I want to buy, 1,000 here, 1,000 here, and 1,000 here. You could put limit orders into the system. The way that martingale is a little bit different is it just kind of automates that. And it also automates the size increase. So you can actually put more in as the price falls. And that's what's known as a martingale strategy, right? So you put more in, you buy a dip with more over time, trying to get your average price drawn down to a lower level. And then as the price moves back up, you actually automate the sell as well. So you can see the strategy here is that you want to go long the asset. So we're trading Bitcoin here. So you want to go long and you want to set a price decrease. This is an AI strategy here, but you can manually input this as well with all these parameters, right? So price decrease here. So let's say every 2%. you want to multiply that. I'm going to put that 1, right? So what that's saying is I want to trade every 2%, and I don't want to multiply that difference. If you multiply the difference, then that 2%, each drop will actually gain by 20%. So it won't be 2%, it'll be 2% times 1.2%, then that times 1.2%, which is 20% more each time. We'll just go to AI so I can just show you these parameters, right? So the position multiplier on this one's actually 20%. So it's actually increasing the price move each time to the downside that you get in. And we have 4 additions per round, meaning that we want to trade 4 times in as the price drops. And then you want to make a target of 2.9% to the upside. What will happen here is that it will buy in, it will sell at that 2.9% profit, and then it hopes to and aims to buy again if the price dips, and then sell again, and it auto refreshes for you. So again, slightly like a trading bot or a grid bot in that instance, is that this rolls and rolls and rolls for you. But you may not want to do this. And again, it may just be better to dollar cost average the asset and actually wait, because you're taking profits here at 2.9%. Okay, that's fine. Well, what if you just wait for a year? Bitcoin annualizes maybe 40% a year as I'm making this video. Why don't you just wait and not sell and actually make more money? So, why actively trade if you can just wait and actually gain more out of dollar cost averaging the assets? But that's how this works. Is that it's a strategy to actively trade where you get in at certain intervals and then it aims to sell them out and then refresh that bot over time. So you can do that either in the futures market here, long or short. Obviously, short to the upside is trying to sell up and then buying back as the price dips as well. This one might be good if you think Bitcoin is in a bull market. It gets a lot of drawdowns, right? So you want to buy those drawdowns. Again, you can do this manually via limit orders or just actively participating in drawdowns, or you can try and set this up yourself. But this is way more short term and way smaller as well, right? Like 2.9% profit is your target here. Bitcoin at the moment can draw down 20, 25, 30% and then go up 50%. And so you're kind of cutting all of that short and trading much more actively short term, which may or may not be a good thing. That's up to the individual to choose that. Now let's have a look at the Bybit Card, which is a prepaid MasterCard. So this actually lets you spend balances from your Bybit account, either from crypto, or you can switch from crypto into fiat currency first to load the card and then spend. But this is insanely good for crypto users, I think, because it solves a lot of pain points. There are some nuances as well with crypto cards, including tax implications of spending crypto and some of the fees and limits as well, which you have to be aware of. So I'll go through all of that. But some of the benefits, especially if you're in VIP, are super attractive if you're a Bybit user anyway. When Bybit launched the card, they had a set of rewards, but they've added to those over time as well. So it says up to 10% cash back when you spend the card. However, this relies on certain VIP tiers on Bybit as well. So many people have used Bybit for a long time and they trade on there. And obviously this card is something you can apply for. And then if you're in any of the VIP tiers, you can get bigger discounts as you go up the tiers as well. So one of the first things they did was bring on TradingView subscriptions and then Netflix, Spotify, and Prime. So you can see down here, it depends on your VIP tier. Essentially, if you're in any of the VIP tiers, then you get rebates on those. So if you spend on TradingView, I know a lot of people have TradingView as well. Netflix, Spotify, you can get rebates if you're in one of the Bybit VIP tiers. You can also get these points as well. And so depending on the VIP tier, you get cash back when you spend, but that's up to a limit per month. So again, you can see this as well. So, even if you're non-VIP, you actually do get cash back, which is effective 2% cash back on the card, up to $10 monthly. And then as you go up, that gets more. In the higher VIP tiers, you actually get up to 4, 6, 8, and 10% as a cash back. Again, with some limit here. But that's obviously great to just get actual cash back. Now, I'll show you how that works in the app, because they just actually give you the stable US dollar stable coins, USDT, as cashback. Then you can use that in your trading account, or you can just use it for purchases somewhere else if you want to use that on the card and spend it on the card. You can do whatever you want with that, but that is real cashback. And a lot of other card programs have completely taken that off. For example, crypto.coms, they give you cash back in CRO coin, which is, okay, you can sell out of it, but this is way better because they give you the cash in your account. They give you the USDT in your account. You can trade it for super low fees, or you can just keep it in your card. And you get the purchase rebates. That's what they added initially. And then from here, as you can see, new users get up to 10% cash back here as well. Again, there are some terms and conditions there, but that's a kind of an offer that's running for right now. So that will run out depending on when you're looking at the video. They also just reached 1 million cards issued. So they're doing additional cash back right here as an incentive. They've added this, which is these lounges for airports as well, which is very popular for cards, right? So they've added this recently, and then save up to 6% on hotels worldwide with N Travel as well with the card. So those benefits, I think they're pretty good overall, but again, it depends on your VIP tiers and everything like that. In any case, I'll leave that link below as new users get some sort of discount, right? So you can see that when you're watching this, it may have run out. Again, these can change over time. So best to just view it when you're watching this and see what the benefits are when you're signing up. I'll show you exactly how to sign up and what you need. The best thing about this card program for right now anyway, is that it doesn't cost anything to apply. It doesn't cost anything to have the card, and it doesn't cost anything to cancel the card out. And other programs do actually charge you some fees around that sometimes as well. So for right now, that's great. Again, that may change in the future. That's just what it is right now. So card application, go to the card app in your phone, apply, and it says virtual card under review. You get a virtual card first, pretty much immediately, as long as they accept you in, which they should do if you've done KYC on the platform, right? So you need to do KYC, which is give them a ID card or a passport, scan your face, pass KYC verification. Everyone that uses Bybit already would have done that. And then they'll just accept you into that card program if they're issuing it in your region. That's the virtual card that you get immediately. Now, if you want to apply for the physical card as well, you obviously have to give them your address. So put your address in like this. Down here, it says reason. I had no idea what that was. I think I just put the give me card in there and it just went through. So I don't think you need to put anything in here other than just something like that. It doesn't matter. And then edit your address, make sure that's correct. And then it goes through to the application process here where it gives you your name that you want on the card and your address that they're going to send it to. And so you can do that, and then you can set a PIN once you have the card as well. And then you have to give them a mobile phone number. I think this is for the delivery agent to actually deliver the card for you. And then right here, it says application successful. That's going to take a while to actually send the card out for you. From there, it's going to let you into the app, because the app actually lets us use the virtual card immediately. So I'll just show you this in the app, where up at the top, you can scroll down, and then it gives you physical and virtual. These are just MasterCards, so you can spend them just like anything else, right? You're just spending in any shop that accepts MasterCard here, and you can add the cards to Apple and Google Pay as well. So you can tap to pay, and it just charges your Apple or Google Pay just like any other card you have. The Bybit card is a prepaid MasterCard. So you can see the physical card right here and what it looks like. It just says prepaid MasterCard. You can use tap to pay, you can add it to your Google and Apple Pay, and then just spend in shops. However, it matters what you have in the card in your app to spend with. This is really important before spending anything on the card, to know what exactly you're spending and how that works. So these are the fees and limits for the card. So the Europe card right here, the base currency of the card is Euro. And then for Australia, I believe it's USD, not AUD. It may be AUD. You'll have to check in your region if you're Australian, just to make sure what the base currency of the card is, because the base currency of the card is really important. When you spend on the card, there may be a foreign exchange fee, or if you're spending in a different country or a different currency to the base currency of the card. So I'll show you the European card with euros. You can make that into your currency as well. So there's a foreign exchange fee if you spend in a different currency than the base currency of the card. So if I'm in Europe and I have a Euro card and I spend in euros, there's no foreign exchange fee, right? But if I'm in Europe and I have a Euro card and I go on holiday to America and spend in US dollars, I have to change from the base currency of the card in euros to dollars, which is a foreign exchange fee, which is 0.5% from MasterCard. So that's the MasterCard fee, right? If you're spending on the same base currency as the card and you have that fiat currency in your Bybit account, there's no fees. There's no fees at all, because you're spending on the base currency just like any other card that you don't pay. Now, if you have a foreign exchange fee, that's on top. The crypto conversion fee as well is if you have crypto on the card that they have to switch into a fiat currency to spend. So I'll show you two ways to do this, where you either pay this higher fee or you pay the lower fee. FX padding is 0. That's if you do a foreign currency transaction. Annual fee, none. Inactivity and cancellation fees, none. And if you can see here, replacement fee, there's a small charge, but not for VIPs. And then down here, you have the ATM withdrawal fee after a certain amount. You can see that here. So these are the fees on the card, but it's really important to know what you're spending and why. So let's go through an example here. Let's say that you have Bitcoin in your crypto account and you want to spend on your card. Let's say that you're in the EU and you're spending in euros, which is the base currency of the card. I've got Bitcoin. Now, what I could do is put the Bitcoin in my funding account and let the card spend it. That is going to incur a conversion fee from Bitcoin to euros. And we don't want to pay that. So what I would suggest is actually trading the Bitcoin for euros first. So go into your Bybit spot trading account. You can come up here to trade, spot, go to Bitcoin USDT or Bitcoin Euro, sorry. So we're doing a Euro example. So I'm going to go to the Euro trading pair here, trade Bitcoin Euros. I'm going to sell Bitcoin into Euros. That puts Euros in my account. Now I can spend Euros on the card for nothing. The spot trading fee on Bybit is 0.1% to change Bitcoin into Euros. I have Euro fiat currency in my account. I spend Euros in Europe. There's no other fees. That's insane, right? It's great. Now that would be the same as if you did that from Bybit and you send the Euros back into your bank account and spend on the card. It's exactly the same thing. Now, if you don't do that and you let Bybit convert the crypto at the time of spend, they charge you that 0.9% conversion fee. Not the end of the world, but it's something you can avoid. So if you could avoid it, I would recommend it. Now, if you spend in a different country, so we've got a Euro card with Euro-based currency, and we go to America on holiday, well, we're going to have to pay the conversion fee from euros to spend in dollars, which means we pay the MasterCard conversion fee, which as we saw was 0.5%, but it may go up in different regions. So that's 0.5% as a conversion fee, which again isn't the end of the world, plus any other fees that you may incur. So if you've traded out from Bitcoin into euros, that's 0.1% extra for the trade. And if you didn't and you let them convert it, then they have to convert, which is 0.9%, and do the fee, which is 0.5%. So, 1.4% you'd be paying for that card transaction if you have the crypto conversion and you're spending in a different currency to the card. So just be aware of that. I think these fees are actually super, okay, to be honest, compared to other cards and everything like that. So I don't think it's the end of the world. Even if you have a bank card that you spend in a different currency, you'll be paying a foreign transaction fee anyway. So it's just maybe avoiding this if you can. Now, there is also 2% cashback that you get on the card, even in the non-VIP tier, up to $10 a month anyway. And if you're in VIP tiers, that goes up. So that basically takes all of the fees out of the card anyway, even if you're spending crypto conversions. So yeah, I think the fees are pretty good, but just to be aware exactly what they are before you spend, I'll leave the link to that grid as well below so you can have a look. Another thing to figure out when you're spending from the card is which currencies you actually want to pay with. So in the main card screen, go to this right here where it says pay with. It takes you through to this page, and then you can choose these assets to actually liquidate when you spend on the card. However, you can choose these crypto assets, right? And you can choose stablecoins. Be really sure of the tax regime in your country, because most countries have capital gains tax when disposing of assets like crypto. So these assets are not categorized as currency, they're categorized as assets. Some stablecoins in some regions may be categorized as currency, and so you can use them just as currency and there's no capital gains tax to be paid. However, Bitcoin and ETH for sure will be categorized as assets. And so when you sell them, you lock in either a capital gain or a loss. And so if there's a capital gain, you would have to go ahead and register that and pay any capital gains tax that is due. So I wouldn't go around like willy-nilly spending, ETH and BTC on coffee, and you have like 15 million transactions, and you've got to work out where you bought them and where you sold them. Total nightmare. So what I would suggest is if you are selling some of your crypto assets to spend, sell these in a chunk first. So sell a chunk of them for the month, and then spend from the stablecoin or the fiat currency that you sell to, which is going to make things a lot easier. So definitely be aware of that before spending on this crypto card or any other crypto card. And then from here as well, right here it says auto savings. Auto cashback is on, so you get that cashback. Auto savings is where you can actually put some of these crypto assets in Bybit savings, which get an interest rate whilst they're waiting to be spent from the card. So I do this with my USDC, just a small amount on there if I want to spend on the card. I put it into auto savings, which is currently getting 9.87%. below $500, and then I think it's like 4.5% above $500. So basically, it's a US dollar bank account with interest that I use to spend in shops or whatever. So it's awesome if you have a US dollar bank account with that amount of interest going to spend in shops. So that's how I would play it. Definitely do not spend these a million times if you have loads of capital gains tax that you need to pay. And you can figure out which assets that you want to spend, either these stable coins in savings, or if you want to put some fiat currency into your funding account, if that's supported as well, you can just spend the fiat currency directly. Now we'll look at Bybit Crypto Loans, which lets you borrow money against the value of crypto asset collateral. This is exactly like taking a mortgage. So you have a house that has a value. The bank gives you a loan to buy the house. But if you don't pay the loan back on the interest, then they take the house. So that's the collateral, is the house. Well, on crypto loans, your collateral is the crypto asset. Bitcoin, ETH, many others. So you borrow an amount. You can actually borrow any asset. It's not just dollars. You can borrow any asset against the value of some collateral that you can put on. So I'm going to borrow dollars or USDT, and I'm going to borrow against staked ETH. But if we just look at other assets, we can trade anything we want. So if you have Bitcoin here or plain ETH or anything else, you can put those on. I'm just going to put some staked ETH into my unified trading account, and I'm going to use that to borrow some dollars. So let's borrow an amount of dollars. We're going to borrow that, and it's going to come to our unified trading account, but you can change this to funding account if you want as well. And I'm going to put the collateral in my unified trading account. So what we can see is the loan term is flexible. There's two types of loan terms, either flexible or fixed. Flexible is flexible interest, flexible time horizon. You can get in and out when you want. Fixed is fixed interest, fixed time horizon. We have to pay back the loan with interest, and if we don't, then they will just take our collateral to get out of the position. So I'm going to borrow $50 against this much collateral here. You can see the summary on the right hand side is that the LTV stands for loan to value. So the loan to value is max 80%, which means that if you put $100 of collateral on, you can only borrow 80% of that, so $80. The reason being, crypto is volatile and they don't want any liquidations or bad debts. And so what's going to happen is you can only borrow 80% of the value of your collateral. The margin call comes at 87%, which is the loan is now 87% of the value of your collateral. 87%, they give you a message saying, hey, look, you need to put more collateral in, or you need to pay off some of the loan to reduce the loan to value. Liquidation happens at 95%, where the loan is 95% of the value of your collateral. They'll just sell your collateral and pay off the loan. So that's how that works. And we're going to borrow $50 against this. You can see the daily interest that we pay. So we're going to press borrow now. We're going to agree to the terms and press yes. And we go ahead and borrow. We're paying 9.37% as an annualized rate right now. You can see I've got some a couple of different loans here. So you can have multiple different loans with different collateral, and you'll just see everything here. You can see this one. What I did is I took a loan, but I didn't have any USDT in my account to pay back. And so we've got this small amount here that I have to actually pay back to repay the loan in full. Otherwise, that will keep racking up. So when you pay back the loan, you need to pay back what you borrowed. So I borrowed USDT. I need USDT plus the interest to pay back. So what we can do is repay this one, and we just put max here. I've got some USDT in my account now, so I can press confirm. And that should pay it back and cancel out the loan. 0% now. And then this one we need to pay back. So I'm going to repay, max, confirm. And that should cancel out that loan. There's also fixed rate loans, which I'll quickly show you. Down here it says fixed rate. So we'll click this. And this fixes the duration of the loan and the interest. You can actually supply and borrow here. This is because this is just a market of people that want to lend and borrow. Bybit do not lend and borrow. They're not a bank. So they just sit in the middle. And if people want to lend and borrow and they match up with duration and interest rate, then they can match those people up, and they probably take a small fee out of the interest rate. So if we want to borrow, we'll press borrow here, borrow 500. And you can see the interest rates, right? So let's say I want to borrow for 7 days. This guy is telling me that he's willing to lend me dollars, $550 for 7 days at 6%. So we'll do 6%, and we can borrow this, guys. So borrow 500 at 6% for 7 days. You can set up your collateral and you can press borrow. And then you take this one right here. So you can see if you want to borrow money for 180 days, then you pay 6.7%, and you can borrow up to $94,000 here. So someone's supplying that. If we want to supply dollars and actually gain an interest rate out of borrowers, then again, 500. And I want to get 6.6%, right? And that means that this guy is willing to borrow at 6.6%, 180 days. You can see the duration here is different, right? So the duration is 7 days here. This guy wants to borrow money for 180 days. This guy wants to borrow for 30 days. You can see these guys are slightly better rates, but they're much lower, right? So let's say that I want to actually supply. This guy is saying, hey, look, I want to borrow dollars for 6.6%, 180 days. So I can match them if I want, and I can go ahead and supply if I have the dollars. So that is fixed rate and fixed term, fixed interest. Lending and borrowing, you can either supply or borrow, or you can go back to the variable rate, but that can change over time. So it's up to you which one you want to use, but you can essentially borrow dollars against crypto, or if you have dollars, you can lend them out to people. That is a run through of the entire Bybit platform. If you're not a user yet, click the link below. You can get a $30,000 deposit bonus, and you can get a fee discount on Apex as well. I'll leave all of the other helpful videos and resources that I mentioned throughout this video down in the description below. I'm James, this is MoneyZG. Cheers for watching, and I'll see you in the next one.